All right, welcome everybody. Day two. Excited to see some of you guys that were here yesterday as well. For all the people watching on YouTube, excited for you guys to take lots of notes. We're gonna get a lot deeper than we did yesterday. We touched on the basics yesterday. Now we're gonna get into options more so you can actually learn about the options contract itself. Talk a little bit about trading plan and trading plans and what's it like to create a trading plan. And then also we're gonna go then deeper into charting, look at trends, what a trend line, how you even identify a trend line, support and resistance, and some more goodies in there, patterns and such. So first, we're going to begin with options here. We're going to start at the first part that you have to start at with options, just like you'd start with shares. Are you buying? Are you selling? We're always buying options here. We don't do any other complicated strategies here. So you can buy to open and you can sell to open. We want to focus on the buy to open. It's going to get a little confusing. I'm going to try and make it less complex for you guys here. So buying to open is when you buy on the ask. When you pull up the options chain, which we'll have a little photo of here in a second, you'll see a bid and an ask. You buy on the ask and then you sell on the bid. So when you have no position in an options contract or any position at all, you are going to click that ask button to open up your order tab and then go through the order like you normally would. And that's how you correctly buy to open an option. And then to sell to close that option, you would then just go to that option that's sitting in your broker, click it, click the sell button, and then go through that process to sell it. But if you didn't know how to do it, you could also click the bid on the exact same strike that you already had. So there is an option to sell to open, and that's if you have no position and you click the bid, and that would open the position, therefore, on the bid. And that's a different world. Like I said, we at iTrends, we don't do any sell to opens. It's just buy to open. So when you have a stock and let's take Microsoft, for example, and you're taking a bullish bet on it, you're saying, okay, the stock is going to rise 3 points. You want to buy to open the call side of that, right? Because you're saying, okay, the stock is going to go up. We don't do any type with sell to open. You're just buying to open on the ask. So let me get my little laser here as well. So there is a big difference between buying versus selling, like I just went over. The main thing that you need to know is that buying to open a call, so buying on the ask is bullish when you buy a call, and buying on the ask on the put side is bearish when you buy that put. So you're going to buy on the ask, whether you're buying a call or a put, and you're making sure that you're buying that on the ask so that you have that bullish call or that bearish put. Don't click the bid. If you have no position, do not click the bid. So let's continue going. What is a bid and what is an ask? So on the left here, you see the bid is on a stock is the highest price that a buyer is willing to purchase the stock from you. The ask is the ask on the stock, excuse me, is the minimum price that the seller is willing to sell the stock to you when you buy it. So again, just focus on the fact that you are buying on the ask, and then when you go to sell, just click that order in your broker and then go through the sell process. Click that ask and you'll have no issues. Once you get into the other realm of clicking the big bid, it gets a little bit more complex. At iTrends, all we do is buy on the ask. Buy on the ask, buy on the ask, buy on the ask. Buy to open, then sell to close. That's all we're interested in here. Make things a lot simpler. So if you've opened up the options chain in your broker or broker at all, maybe you're not using that broker, but if you've looked at an options chain, you'll see that there's an ask price and a bid price, and you'll see a spread or a difference in price between the two. So there's going to be a large or small difference in between the ask price and the bid price, and that's known as the spread. So there's a couple important things to note about this. One is that a wider spread on the ask and the bid. Right here, as you can see, the ask is 770 and the bid is 550. That's indicating that you have an illiquid stock. Illiquid just means that you have low volume, nobody's home. So that's not necessarily where you want to be in the stock world. So if you ever go to a stock like NILE, it might change from time to time, but let's just use this photo for example. You went to NILE and you saw, okay, there's a huge spread. It might not be the best stock to trade options in, because if you think about it, if you fill on the ask at $7.70, you then are forced to sell. If you were to sell it a second later, you're forced to sell at $5.50, excuse me. So you're automatically down $1.20, or in options terms, $120 on a contract. So you want to make sure that when you're picking your options, your spread is tight. It's okay to be 15 cents, 20 cents, you know, on a Moderna, you might be at like 50 cents, 60 cents. It's okay to have a spread. Just be very mindful of the fact that if you're on a stock that's not so volatile, so it's not moving a lot, your spread is really going to impact your probability of being profitable on that strike. I mean, on that contract, excuse me. If we look over to the right here, Apple, very liquid stock. People are trading it all day long. So your spread, excuse me, is much tighter. It's only 10 cents. So 355 on the ask price here, 345 on the bid. So if you were to buy and then immediately sell this for whatever reason, let's just say hypothetically speaking, you were to buy and immediately sell it, you would have been down 10 cents a contract versus over here, again, you would have been down $1.20 a contract, or excuse me, $2.20 contract. I said $1.20 before. So you want to make sure that you have a tight spread, and you do so by looking at the stock and making sure that there's actually people home in those contracts. There's volume in those contracts. So let's keep going. Let's keep on going. So the options, Greeks. This is important to know. Sorry, my chair keeps falling. This is important to know, and it can be a little confusing. So I'm going to try and break it down as simple as possible. So the reason why options are lucrative is because it's not a one-to-one game. Let's take it back to shares, right? If you buy a share of a company at $100, just one share, you spend $100. If it goes up $1, you make $1, right? If it goes down $1, you make $1. Or you lose $1. There's no if, ands, or buts. You just make one or lose $1 in that $1 price movement. And options, it's different. You have Greeks, quote unquote, that influence the price of the contract. Therefore, a dollar move might make you $80, it might make you $120, it might make you $100. But the Greeks give you leverage inside of the options, and that's why options is so lucrative. So one of the Greeks, the very first Greek that people pay attention to is the theta, which is just time decay. So theta stands for time decay. Time decay is that, say you have an option contract that has a lifespan of 7 days. So you have an expiration or you have a contract that expires in 7 days. Time decay will slowly take away the value of that contract over that 7-day period. That time decay might be like $14. So you might lose $14 over the course of 7 days. 7 days, $14, $14, $14. And it's not instant. You don't see it reflect instantly. It happens all throughout a 24-hour period. So you don't see it. It's not like it doesn't come up and say, oh, theta has taken away $14. It just happens over that 24-hour. It just decays and decays and decays. It just decays and decays and decays. So it's important to note that theta is something to take in consideration when you're in a higher beta stock like Tesla or Amazon. Those will have higher theta. So you want to pay attention to it, because if the stock isn't moving in the direction that you need it to move in as quick as you anticipated, and that theta is going to kick in and decay the value of that contract, no matter if the stock just stays at zero and flatlines. The delta is the next Greek that we're going to look at. Delta is just the dollar movement. So if a stock moves $1, the contract will move X amount of dollars. That's what your delta is telling you. So if the stock or the contract's delta is $14, every dollar move in the stock will be $14. That's the leverage aspect to it. You have gamma, which is delta's cousin. That's just the change of delta relative to the change in the underlying stock. So I don't want to make it too confusing here, but this is just, think of it as the enhancement to delta. So delta will stay at $14. It might move from day to day, like Monday it might be 14, might be 15 on Tuesday, but it'll stay there, 14, 15 cents, and move. And then gamma will come in and change it. It'll add a little bit on. Say it adds like $2 on, and then maybe it takes $2 off. So the gamma is there to kind of influence that delta, that dollar movement per dollar movement in the stock. The Vega, not paid attention to at all on any day trader's life, and therefore we're not going to go over it. The IV is not a Greek, but it is another thing that impacts the option, and it's, in my opinion, the most important thing. I just had a voice crack. The most important thing in options contracts, implied volatility. Implied volatility impacts the gamma, which then impacts the delta. So this is really, really important concept to understand and know. And some of you traders might have actually already gone through something like this. It's called an IV crush. So your implied volatility It's just how volatile the contract is in the future is essentially what it's predicting for you. The IV will fluctuate based off of the supply and demand of the actual contract. So supply and demand, right, is just buying and selling. So if the overall buying and selling is going up, then the IV will go up. But if the overall buying and selling is coming down, then the IV will come down. So this is why you have situations, and I'm not going to go over all this, but this will be a slide that'll be in the Discord, the community, and you can check it out and read it on your own terms for sure, because there's a lot of text here, but we figured we just put it in there. So this happens. What happens when you have an IV crush is like you being, let's say Tesla is having just immense buying pressure. So it's just trending up and up and up and up and up, and you're riding the contract all the way up, right? All the way up, and you don't sell at your resistance point, and all these sellers come in. So all these sellers come in, bring Tesla all the way back down. The contract in that uptrend, in that movement that you captured, might have went up, say, let's just say, hypothetically speaking, 200%. And it went up 200% in that move. And then the one candle of all the sellers that brought it back down, like a third of that entire move, brought the contract down to like 50% because the IV crushed the contract. You had all of the buying and selling stop in the contract, and then IV just crushed it. So it's very important to be aware of that when you're in a higher beta stock like Tesla, Amazon, or just in a shorter duration or shorter expiration of your contracts, because your IV is going to be higher. Therefore, it can crush and crash higher. So you have to be very careful of that, because some people will get into a contract that has 0 days on it on Tesla and then trade up to the resistance, not think to take profits, and then the stock retraces 50% of that move, and then they're negative on the contract. And they're like, what the heck just happened? It's IV. So again, like I said, we're going to put this into the actual Discord itself. You guys can read this through. If you have any questions, just reach out to us. It is kind of complex, but you will see if you just watch the way your contract moves, even in a simulated contract, watch the way it moves, and you'll see the drastic movements in it are caused by IV. Hopefully this is making sense. If this is making sense, can I just get a yes in the chat by a couple people so that I know? If not, I will go over or re-go over something. Makes sense? Yes, Lauren?
Yes, makes sense.
Got it. Thank you, Polanco. Makes sense. Got it. Yes, yes. Okay, good. So I'm glad you guys got through that. That's very, very important to know. So let's move forward. So picking the right contract, we kind of have to pick the right contract when we're trading options, right? Because if you're picking the wrong contract, that's obviously not a good situation to be in. So this is Webull right here. You saw a screenshot of it yesterday. This is what the options chain looks like on a larger view here. On my options chain here, I have implied volatility, right? That's what we just went over, the IV, the implied volatility, open interest, volume, the last price of the contract, the ask and the bid. And then on the other side, you can see it's over here as well. So liquidity or volume is king here. We're looking for the volume. We want to follow the flow in the market, right? As options traders, we're volatility traders, which means that we're trading the volume. That's why we look at high volume stocks like Apple, Microsoft, NVIDIA, AMD. They have lots of people buying that. So we want to be in with those people. We want to recognize where that volume's flowing, right? So we want to do the same in the options chain when we're choosing our options contract. Right off the bat, before we go a little bit deeper, I do want to say one thing. One thing about options trading is that you do not want to be so far out of the money, which means that if the stock is at 200 and you're trying to trade a $250 strike contract, you're $50 out of the money. The chances of the stock moving even remotely close to that price point is really, really unlikely. So you might have a nice movement in the contract, steady movement on the upside, but if the stock begins to fall, your contract is going to get absolutely destroyed, for lack of a better word. It's going to get destroyed because you're so far from that strike that you're saying that the stock is going to go to. You're 50 points off, which is 25% of the entire stock price, right? So with that being said, we want to stay closer to the money when we're trading options, just as a relative statement, right? And just as a relative statement, closer to the money in the options chain. So if we look here, this is the call side on the left, and this is the put side on the right here. So the red, this is technically in the money. So in the money on the call side is going to be any price below the stock price. So if the stock is at, let's just say here, the stock is at $234.45. So all of these strikes below that $234.45 are in the money, right? And then on the put side, the stock is at $234.45, right? So any strike price that is above that is in the money on the put side. This is out of the money. Hopefully that makes sense. Then, as you can see, the green highlighted is out of the money. So if anybody needs me to explain that, please let me know right now, so I can go a little bit further into that. I just want to make sure that that concept makes sense. Okay, one more time. That's all I needed. So in the money contracts on a call side, so we're making a bullish bet on the stock. So when we take a call position, we're saying, okay, Microsoft, or in this case, let's just use this, right? This is the example. Moderna is going to go up. Let's just say it's going to go up. We don't have a price target yet. We just know it's going to go up. So we're going to take calls on that position. We're going to buy on the ask, of course, but anything that is below that price that the stock is at, currently the stock is at $234.45 in this example. So any strike price below that $234.45 is in the money, meaning that the stock has already progressed above those levels. So any contract that you pick below that $234.45 is in the money. And then any contract that you pick that's above that price on the stock, $234.45, is out of the money because you haven't reached that price yet, right? You're making that bullish bet. And then it's just the exact opposite on the put side. So on the put side, you're making a bearish bet. You're saying, okay, Moderna is going down. We don't have a price target, but it's going down. So the stock is at $234.45. Any put that is in the money is going to be above that price because you're saying that the stock is coming down. So therefore, it's already come down from 255, and it's already come down from 252 and a half, 250, 247 and a half, et cetera, et cetera, et cetera, et cetera. And then anything that's out of the money is then going to be where the stock hasn't hit yet. You're making that bearish bet. You're saying that it's coming down. So the stock hasn't gotten to $232.05, hasn't gotten to 230 yet, hasn't gotten to 227 and a half yet. So that's an out of the money contract. So hopefully that makes sense. Yes, correct. So let's take a look here at this as a proper example. Let's make a real example out of this. So let's just actually, let's skip here. Let's take these assumptions, right? So let's make these assumptions here on the stock. So we're bullish and we're buying to open calls, right? We don't do anything else. We buy on the ask, buying to open, right? So we have an assumed price target right here of $237, and the stock is at $234.45. So let's just get that right? $234 is what Moderna is sitting at. We have a price target of $237 on the day. So we are going to buy calls, right? So we're bullish, we're buying to open calls. Now let's figure out what contracts we want to get in, right? So we look down the chain, we see 235, right? We see 240, we see 245 and 250. The reasons why I blocked out these in-betweens is because they're not whole numbers. And generally speaking, as a rule of thumb, your 242 and a half, the 0.5 strikes are going to have a lot less volume than the whole numbers like 240, 245, 250, 255. And that's just psychologically kind of should make sense, because if you think about it, a stock is going to go to more likely to go to 100 before hitting sellers rather than 101, right? Or like 105 rather than 106. So it's all the whole numbers are always going to have more volume in them. So we're going to take a look at specifically the 240, the 245, and the 250s. So if we look down the chain all the way at the 250s here, you can see that this is where the most people are present. You can see that this is volume, right? And this is open interest. So you got 2,700 people interested in this contract here. They either have positions or they have open orders waiting to be filled on them. This is the volume on the day. So 673 people have bought this position, right? So this is clearly where everybody's looking at 250. Okay, so our price target at 237, it might hit today, but people are saying, okay, by this expiration, which is that's irrelevant right now. By this expiration, the stock is going to trend towards $250. Then you go back down to 245. You see, okay, we've got 614 people here that are interested in the contract. They've either got the open positions or the open orders waiting to be filled. And then the volume, there's 270 people that have actually filled this contract today. And then we go down to the 240s and we see, okay, 766 people are interested, open orders, or they've already have their orders filled. And then 301 people have actually bought the contract today. And then 235, you can see here is 787 open interest and 94 volume. That's great, but these are also expensive contracts. So we're not buying those expensive contracts, right? So let's say that 235 was way too expensive for our blood. $945 a contract. We've got a $2,000 account. We've got a $5,000 account, something like that. Too expensive for our blood. So we need to buy a little bit further out of the money. Keeping in mind that we have that 237 price target, right? 250, even though it looks the best with all this open interest and volume here, that's just too far out of the money for what we're looking at the stock to move on the day, right? Because we're day trading. This is too much. It's not going to go to 250. That's a big, big move. So that's too far out. So we kind of have to, even though that's the sexiest, it's got all the people in it, it's got all the open interest, we're going to have to toss that to the side because that's far too far out of the money. If the stock is at 235 and the strike price is 250, that's $15 out of the money. That's almost 10% move in the stock on a day. Too far. We don't want to be there. So we have to move up. Look at these 245s, right? And so the 245s are $5.30 on the ask. Okay, that's a good price. We can afford that on a $5,000 account, right? 10% of the account. Good open interest, good volume. Okay, good. Let's take a look at the 240s. Those are at 710. Okay, that's kind of getting a little too expensive, but we're closer to the money. We're closer to $234. So that is an advantage for us, right? A lot of open interest, a lot of volume. Okay, good. So now we just have to pick for ourselves, are we willing to risk $7.10 or are we rather willing to risk $530 per contract to be $10 out of the money rather than just $5 out of the money? And you have to make that decision for yourself. Personally, if I had a $5,000 account and I was looking at this exact trade, the holes, everything was the same, 237 was the price target. It's already moved 4% on the day, et cetera, et cetera. We're buying to open calls, bullish standpoint. The 250s are too far out of the money. 235s too rich for my blood. I don't personally would not want to be in these at $7 because that's like 12% of my account. With a $5,000 account, I'm okay risking 10% of my account on this trade with how bullish my sentiment is on here. And I know that, okay, 10% out of, or $10 out of the money isn't too far out of the money for me to be putting myself at too much risk for the actual movement in the stock. So hopefully this example kind of makes sense. I know it's totally, it's a little bit more further advanced than we just kind of jump from what is options into this example, but hopefully this does make sense. Let's see. Poke says, from the previous slide, is the spread so far apart? Oh, too far apart. Right here, 30 cents on here. The spread on this, pretty far. Spread on this, 40 cents. That's pretty, I mean, $700 versus 40 cents. You know, that's like 5% of your contract. So not too bad. You have to make 5% to then cover that spread.
You
Right
also
here,
have to
30
think about
cents.
the price of these contracts, like the contracts he's looking at. You know, if we're going off the bid side, you're looking at $860. So that top spread but that's close to the money, you're going to have a farther out spread. You're normally looking at like 50 to 75 cents is the range you want to stay in. As you get farther out, those spreads tend to tighten up unless then that's because there's volume. As you can see, these have a lot of volume, which tightens up the spread. But the farther out you go, the tighter you want it. So if we look at the 250 strike, you know, you're sitting there at 30 cents. that's not terrible, but you also know that you can hunt the fill, meaning that there's enough volume there and there's enough action to where you can actually get filled at a certain price. Now, when there's lower volume, that spread's going to tighten, that spread's going to spread out and widen out. So you just want to be careful with your fills. But when you're looking at a contract that's sitting in the let's say $400 level, you're looking at 25, 30 cents. You get up in the 500s, scale it up as you go in.
So next slide, we're going to talk about, Spence just briefly mentioned it. He said he used this phrase, hunt the fill. Hunting the fill just means that you are taking control of what you want to get filled at. Nobody else is deciding for you. So, right, that contract on the ask, that 245 strike contract on the example was $5.30. You don't have to fill at $5.30. Say you look at the chart and you say, I can get a better fill than this. I don't know what it might be. It might be 470, it might be 490, but I know that I can get a little bit better of a fill than that. You don't have to just go by what the market is telling you. You don't have to say, oh, I just need to fill here. They don't have control over that. You have control over that, but you have to make sure that you select the correct option to take control over that. So when you're buying anything, whether it's a share or an option or a different type of derivative, you should never, ever be buying on market. The reason why you shouldn't be buying on market is because you relinquish all the control at that point. You give the market the control to essentially say, I'm going to fill you at whatever price that is, whatever price they want to fill you at. So somebody might be putting in their order. Let's just give an example here. That contract was $5.30, right? And you wanted to buy it at $5.30. But somebody else put an order to sell theirs at $6.30. If you go at market, there's a small chance that you might fill at $6.30, even though the contract didn't move to $6.30. So you're giving up your control when you're using the market way to enter a trade, whether again, it's shares or options, doesn't matter. You'll have the option on both, whether you want market or limit here, which is what you see, which is the far superior, the only way that you should trade, regardless, again, options, shares. Because when you have a limit, you take full control and you say to the market, no, I don't want to buy it at what you want me to buy it at. I want to buy it at what I want to buy it at, right? And so that might be, in this example, $5.35. So if the contract goes up to $5.45, it's not going to fill you immediately. It's only going to fill you when the contract moves through that $5.35 range. And that's when you'll get filled. Whereas again, if you do the market, you have that small chance. And believe me, it's happened. It's a small chance, but it happens to every trader somehow. It's small, but it happens to every trader. So it's definitely happened to me where I put in that market and then the market fills me way higher than I want to be. So that's really unfair if you think about it. So you need to make sure that you retain the most control when you're trading, right? That's the whole idea. You don't want somebody else controlling this for you. You want to be in control of what's going on. You want to be in control when you're buying, when you're selling, and at what price you're filling on both sides. So in order to do that, make sure you're buying with the limit order. So when you bring up your broker, this is Thinkorswim, the phone app. So when you bring up your broker, you go to execute the trade, you buy on the ask, you click the ask button. Not always, but most of the time the default will be market. Just make sure you click through and find the limit. It'll be limit order or limit buy, limit sell on the sell side, whatever. And make sure you have limit and then put in your limit that you want to buy it at. There are certain brokers where you can actually have it trace the price of the contract, right? So here you can actually see that right here. It says limit lock. So if I were to lock it, so if I were to click it and then the lock were to be, locked, then it would be locked on $5.35 and the contract, the limit price wouldn't move. But since it's unlocked here, as the contract is swaying, $5.35, $5.20, $5.45, the limit is going to move with it. So you're looking at the chart and you're saying to yourself, okay, I'm waiting for confirmation. You have the order page pulled up with your limit order ready to go. You're looking at it, okay, boom, give me my confirmation. And then maybe the contract moved up 10 cents. It's moving with you. You click open position or buy, etc. on the limit, boom, you'll get filled on the limit. And then now you're in the trade. And then now you just have to deal with selling and it's going to be the same exact process. So the main lesson from this is just make sure that you are on limit order and not market. I promise you, if you do market enough times, you will get messed up and it's not very fun. Not very fun. So anyway, I'm going to pass this back to Spencer over here. I'm going to give him the host, and he is going to take it from here, show you some good stuff on how to buy time on contracts, what it's like to actually buy time on contracts, what that even means, and when the correct time to do so is.
Zach, showing screen.
Yeah, just click the slideshow and it should be good.
And we're in.
Before you head on, that made sense, right? You guys know what I'm talking about. But when you see the limit and you see the actual market version when you're ordering here, or when you're taking an order or placing an order. Excuse me. Okay, very good. That makes sense. All right, carry on, Spence. Go ahead.
All right, y'all. So we're going to talk about when to play time and what that. Sorry, someone trying to enter. Anyways, so we're going to talk about when to play time, what that means. So when we're talking about playing time, it refers to buying time or days on your contract. So if you're expecting a move to come into a play and you're looking at for a farther outdated contract, that's what we're talking about buying time. You're trying to capitalize the whole movement of the play. And if it's looking like it's going to take a couple days or how you have it charted out, you're going to want to buy time. There's two reasons you want to buy time, because it's going to give you protection and you'll be able to capitalize on the full move. Now on this chart, you can see that there is a bull flag. Where's that laser at? Hold on.
Press L on your keyboard and it should come up.
No bueno.
Bottom left. Just hover over the bottom left and then click the three dots. Yeah. 3 dots.
Cool. All right. Thank you. I appreciate it. Anyways, so here we've noticed that there is a flag looking like to be a breakout right here after this coming up farther out. And we noticed that when we charted this out, we charted the continuation out, we can see that it's going to take more than at least 10 days by our predictions. We're trying to capitalize on this full movement. So this is where we're looking at buying time. If it's going to take at least 10 days, the first contracts you want to start looking at is going to be your next monthly expiry. So this happened on the 14th, and we were looking for, and the expiration for the monthly contracts was the 17th. So we would look at the further out days because the 3 days coming in wasn't enough. So we needed longer out time. So we're going to move to the next month because we want to capture this whole movement. Then if you wanted to get a little cheaper contracts and the volume still makes sense, you could look at a 21 days out to refer to getting a little cheaper, getting a little more accurate, but you just have to be accurate with where you're looking at in your position. But buying time just refers to buying enough room for yourself so that you can capitalize on the movement. Now, when we're talking about buying time, there's different time frames that you want to consider when you're looking at what contract or how much time you may need. Now, if you're doing a scalp trade, most players are looking at weekly contracts, so that way they can capture those small movements. Or another thing that they'll take a look at to scalp, which is 0 DTE. Now, if you are a beginner trader, I would say step back. These are very volatile contracts. Like Zach was saying, 0 DTE, really high IV, implied volatilities there. And the Greeks come in and they really take a hold of those contracts. But as a scalp trade, you can actually really increase your position because those 0 DTE contracts tend to move. They tend to be cheaper. And then if you're on the right strike and you're making the right predictions, then those contracts can be very lucrative. Now, if you're looking at a day trade, most traders are looking at weekly contracts on a Monday and a Wednesday, and then switching to longer dated contracts that Thursday and Friday. And that's because on Monday to Wednesday, that's when the premiums for those contracts, the weekly contracts, are going to be at their highest. Now, at iTrends, we have our community reviews on Sunday and on Wednesday. The reason we do that is because on Wednesday, this is when the values start really to decay. Not only Theta steps in, but the other Greeks step in, and they really do change the contract price coming into that Thursday, Friday. And that Friday turns into, some people call it a lotto Friday, 0 DTE day, but that just means that IV is really high. So day traders, most likely when it comes to Wednesday, and they're still looking at a trade, they'll fall over into the next week's expiration. Now on a swing trade, most traders are looking at monthly expiring contracts. So when we are looking at a monthly expiry, if you're looking on Webull, and I'll show you when I get there. Sorry. And I'll show you when we get there. Those monthly expiry contracts are also called OPEX. This is when major institutions, they will move their positions into the following week. Now, the best thing about that is you're going to see the highest volume on those contracts, being that if they're charting out a play, let's say they're 5 strikes out of the money, you'll see more volume there unless they're playing the direct week. Now, the weeks in between, that's kind of more for retail traders, but we do see a lot on those monthly expiries, which kind of give you a hint where the large institutions are making their plays going forward. So like I said before, another reason you play time, let's say you were anticipating a trade to move a certain way and somehow the company drops news or there's a shift in the economy. If you have more time on your play, it's not going to be affected as drastic as something were to drop that day and you were in a weekly contract. Let's say you had time on it. You would protect yourself from massive downside, and you would have a chance to reposition yourself because you still have a couple weeks or you still have a week on that contract. So the closer you get to expiration, the riskier and the higher the volatility is. And if we keep following along, as you close the expiry, that's when the Greek starts sticking in. So like I was saying, on that Thursday, Friday, the Greeks step in, and then those start gaining control on the contract. And that's why you can see them pivot really heavily. And you can see big moves made on those last 2 days. So then those Greeks refer to that implied volatility, like I've said a couple times. It's just showing you that IV is just showing you how volatile those contracts will be in the future. And it's what control IV is controlled by the supply and demand of that contract. So that means as the IV goes up, when there are more traders buying the contract and selling the contract, that means there's more implied volatility because people are buying and selling in that range. That's going to swing whoever has control. You're going to see that IV either increase or decrease a little bit, and it'll show you right on the chart. Now, this is really important. This is something I really want to get into, and I talk a lot about it whenever with iTrends, we talk about this a lot. It's creating your trading plan and understanding your charts. This is the most important skill that you have to have when starting trading. I don't care whatever you're doing, you have to set a plan. You have to stick to your goals and you have to make your rules. So if you're thinking about it, we'll think about it just in 3 and 4 simple keys: clear goal, clear demand, clear risk, and a clear path. We're talking about a clear goal as a trader, depending on your account size. You want to have realistic goals, and you want to have rules set and be disciplined and stick to them. You don't want to play the market one way and then the next week change it and the next week change it. Now, obviously, if something's going different, you want to adjust your plan, but you want to stick to it because that's going to show you the most consistency, and that's how you're going to learn, and that's how you're going to grow your account. If we go over here and look at a clear risk, that's when we're talking about setting your keeping your gains consistent and lessen your losses, meaning you want to have a clear risk. You don't want to play each play differently to where you're trying to hit that home run every time or that. If you're sticking to a clear plan and you have that risk in mind where I'm at 20%, I'm cutting these plays, that's where my line in the sand is. You want to stick to that. Now, when we say clear demand, you want to rank your plays and steadily trade the plays and steadily trade those instead of opening too many positions at once. What does that mean? So for myself personally, and with the market we're in, I only trade 3 trades at a time maximum, meaning that I may create a watch list that has 5 or 6 trades on it. And I will open the day and see what's getting the most volume, what has the best movement and how the contracts are moving. And then I'll narrow that search down. There's several days where I'll just focus on QQQ and Apple because they go together, or I may just be focusing on a Tesla trade. But if you have a bazillion positions open, it's very hard to manage that many. And especially in this market, how volatile we are, it's extremely hard to do. So you want to have clear demand. You want to pick your positions and then just play those. Don't try to get really far spread out and not understand where you're at. And when we're talking about a clear path, that's setting an entry and exit point on each play before you get in. That I can't stress this enough, that I've talked to several people where they're like, oh, I saw the watch list and I got in at this price. And I'll ask, where's your exit? Where's your target? Where are you going to take profit? And if you don't know that, then you're just going to simply guess and check, and you won't have your level set on each trade. And in turn, you'll seem a little frantic or a little scurried. So you want to make sure that you're planning your trades out before you're getting into them. I mentioned this on day one. This is the iTrends 4-to-1. This is our developed trading plan. This is what I use. This is what a lot of traders in our Discord use and our community use. I created this personally back in 2008. It's more than 1,000 trades that's been back tested by. We've been modifying it and executing this just to craft it just so it works perfectly. iTrends really picked it up in 2021, and ever since we've been implementing this, we've created over 100 traders at least successfully using this method, understanding this method. And if you grasp it down, it makes taking your profit and staying consistent really, really easy. So what is the process? How iTrends 4-to-1 plan works is buying 4 contracts or buying contracts in groups of 4. That's how you start. The first cut is 25% of your position. So 1 contract, or multiply by how many you have of the set of 4. And that first contract, you're cutting when the play is up 20, 30%. Reason you do that is because you're protecting yourself from an inaccurate entry, and you're also securing gains right out the jump. The second cut of another 25% comes when the position's up 40, 50%, because then you know you locked in 50%. And then once you do that, you set your stop loss to where you made that first cut. So that way, if your contracts go all the way back down, you're not getting completely gutted and letting that trade go red. The third cut comes when that contract's up 65, 75%, because in turn, you'll have 1 contract left and you'll lock in 75%. And if you're doing that on a consistent basis, that's fantastic. You'll see your profits grow significantly. The last cut is known as the runner, and it's meant to capture excess gains. So that being said, you set a point, you set an exit point, you set where you're going to take your profits, and then you let that runner contract capitalize on the rest of the move going forward. So that way you're already in profit and that runner just keeps going. Now, the number one rule of that runner contract, it should never go negative from the first cut position, meaning that not back to even, not back to break even where you lose no money on that. You should always set it at that first cut spot. That being said, that way you're always on any play that we're going green on, you start following this plan, you're at least securing 25% on all your contracts. The goal of the runner is to capture a higher move in the stock. So if we're setting a trailing stop loss, or we're watching that play continue to go and go, that gives you the ability to sit comfort free, knowing that you've already locked in 75% on the trade. That last trade, you locked in 25%, no matter where it goes. I can't tell you the amount of time I hear traders go, oh, I had a trade, it was up like 75, 80%. And then I wanted more, and now it's red. And then by that time has already shifted. The contract value has already shifted as well. Theta stepped in, IV stepped in as well. And it's shifted that position of that contract. So if you're setting that 25% lock, you're always going to be profitable. And then you can think about it as like you're playing with pure profit, and then you can manage that contract risk manually, and you can lock in the rest of that excess gain.
One thing, not to cut you off here, just talking about the iTrends 4-to-1. This is really, really important. So this helped me a lot as a trader. And I just want to give like a little background. Like it definitely takes just once you experience it and you run through it, it doesn't have to be the 4-to-1 like we set up here. Take this and run with it, maybe change it a little bit, however fits your risk profile. Maybe it's cutting one at 15% and then cutting one at 25%, et cetera, et cetera. But taking the profit off the table as you keep as the trade is keep on going and you keep going, it's a lot easier because that emotion, that weight is lifted off your shoulder of like sitting in the trade. You're sitting in the trade. A lot of newer traders are like, okay, where am I going to cut? How is this? This is going great. This is going, what if it goes even greater? And then, like Spence said, sometimes it goes from great to good to uh-oh. And that's risk and stress that we don't want. The weight on our shoulders, we don't want that. So we implemented the 4-to-1 and started teaching it inside of iTrends because it really does lift the weight off the shoulders. Because you take that first 20% off on your contract and you're like, awesome, I just made 20%, whatever dollar value that is. And then you take the second one off and you've got half your position left and you're like, this is awesome. I'm not riding free yet, but I'm very close to riding free. And so riding free would mean if you bought 4 contracts and it was $400 and you took your position off at 20%, you took it off at 30%, and then you took it off at 50%, say, or maybe 60%, you let it run up to 65, you have the opportunity to make that last contract or the last batch of contracts just free, which means that if you set your stop loss at that first cut at 20%, let's say, it's just completely free. So you could say to yourself, this contract could move all the way. I'm going to set my stop loss. I'm going to walk away from the computer, and it's just totally fine. It's taking the weight off because you're taking profits as the trade is playing out. And you're not just waiting until the absolute maximum value that you can just take out of the contract. You're taking profits as you go up. And it becomes a little bit easier to become consistent in that because you have it in your head. It's like, okay, this trade, I'm taking it off at 20, taking it off at 30, taking it off at 50 or 65, etc. I take mine off at 50. I've changed it a little bit for myself. On the third cut, I take mine off at 50. That's just me. You can change it to whatever you would like. But my main point being here is that it really made my trading a lot easier because I'm not like, well, let's see, this trade is really moving nicely here. We might be able to get a lot of value out of this. And then once that doesn't happen, you get all the stress of like, oh, should I just take it off now? But then if I take it off now, I might not be able to get those extra gains. If I just done the iTrends 4-to-1, I would have already captured some gains and gave myself a little leeway, been like, okay, yeah, I can let this trade run a little bit. I'll let the stock move and do its little dance, and then maybe I will get that excess gain that I'm looking for. So anyway, just wanted to step in and say that.
No, that's great. Obviously, set those take profits to where you feel comfortable and run with that. So like Polanco was saying previous that we were trading QQQ and we were cut down to runners. Those contracts went all the way up from 67 cents all the way up to $4.80 or something like that. And in a matter of, I'm not even kidding, 3 minutes, those contracts went from $480 to $200. So if you're using that plan, if you're trailing it up, if you're taking profits that whole time, and you're following the 4-to-1, it was great because it was a free ride after our cut down to runners. That being said, if you're just sitting in the trade, you had $400 in your hand. Now you're back to $200 on a $67 contract, and it just really, really stresses you out. So it's definitely something I recommend implementing when you're going trading, taking those profits to make it risk-free on you.
Also, sorry, I'm cutting in again, but if you don't have the capital to go through with 4-to-1 and you say, oh crap, like that's putting $400 down. I have a $1,500 account, $12,000 account. I don't want to put 20% down on this trade. Then don't do 4-to-1, but just apply that same mentality of taking profits as you go up and having those set profit ranges, those percentage ranges, and then take one off at that percentage range, that first one, make it a little bit easy, make that last one the runner, and just make sure that you're trading accordingly. You don't always have to use it to the 4s, but typically speaking, Spencer and I are buying contracts in lots of 4s at least.
Because like we said on day one, it's not about the amount, it's not about the volume of trades, it's about the volume in the trade. And that's something I can't stress enough, that you really want to focus on your trades and have successful trades rather than opening up a basket of trades and having them go every which way direction. So here we go. We're going to start talking about setting up your charts, setting up your play, setting up how we chart, how we look at things, and we're going to get going. So your step one is going to be your time frame. What time frame should we use? If you're looking at your scalp trade, you're really looking at your 1 day, 1 minute, and your 1 day, 2 minute. If you're on Webull, that'd be looking at the 4 hour and then going down to your 5 minute. And then if you're looking at a day trade, you're really looking at the 5 day, 5 minute, the 20 day, 1 hour, and the 180 day, 4 hour towards the end. And if you're on Webull, that's looking at the day chart or looking at the week chart as well. And then when you're looking at levels in that, we go all the way out on Webull towards that monthly, not really the yearly because it's not consistent right now. But if you're back on TOS, you'd be looking at that 180 day, the 4 hour, and then the 1 year, 1 day as well. And then if you're looking at big ranges, you can look at your 3 year or your max monthly. Those help significantly on TOS as well. This all leads into what kind of trade are you going to use. So we have these labeled out, and you'll have it whenever we post the recording. So you can write these down, but you're looking at your scalp trades. You're profiting off of your small gap up in your small price gaps up in time, typically 15 seconds to 5 minutes. Now, when it comes at morning time for iTrends personally, we've noticed that those trades and those moves when you're in those scalp trades can take little to no time towards that open, or maximum that 5 to 10 minutes. And usually they take like a lot of attention. You have to have your levels set. You have to have tight stops. And because that risk, the win rate is definitely, it's high win rates and it's high risk, meaning that those trades can go either direction. So you have to be on point when you're scalp trading. When you're day trading, you're trying to profit off the full day move. So you're not interested in the little short time frames. You're not trying to take little hits. You're really looking at the stock and seeing where should this end towards end of day. You're looking typically from anywhere from 5 minutes to five hours in a trade. So it requires a lot of discipline, and your extra entry and exits, hey, you have to nail them, because if that trade goes the other way or starts teeter-tottering during the day, those contracts are going to be affected, and that's going to also affect your day trade. Now, your swing trades, you're looking off of the whole move. You're trying to anticipate what that price is going to be on a longer out time frame. It could be over a course of a day, could be a week, or it could be months. So you don't really care what's happening on that intraday movement. You're looking at the stock, you're judging if it's bullish or bearish, what you think the market conditions are, how they're going to affect that stock. And then you're predicting where that play is going to go over the long time frame. So this is really, really important. And this is what mainly all of our analysts focus on, is nailing down is your support and resistance levels. You're trying to identify key levels. This is where you're setting out our ranges based off our support and resistance line. So you need to, so we have to scale out of our time frames first. Always something you think about when you're trying to set your support or resistance. Look left, meaning that you're looking for consolidation. You're looking for where buyers and sellers are bunched together, and they create a common support and resistance level. So when we say support level, what is that? It's an area which the stock price is steady, and the buyers tend to step in and push it back down. So you'll see a stock push up, and at a certain point, the sellers start stepping in, not agreeing with the price, and reject it, and they start pushing the trend back the other way. And vice versa, resistance. It's the area where the stock has trouble breaking and where sellers tend to step in. So that's, you see in an uptrend. Remember, old resistance becomes new support, and vice versa. So how do you locate support and resistance? You're looking for highs and lows, and you're also looking for areas of consolidation. And when I pull up this live example, I'll show you exactly how that is. Now, step 3, you're looking for your entry and your exit points. This is really simple. It's what are you going to do in that trade when it hits a certain price? Where are you going to take your profits? Where are you going to set your stop loss? Where are you going to cut the trade? And this is really key to master that entry and exit point, because that's going to affect not only that contract price, how much you're going to profit, or where you have to set that stop loss, or where you're going to negate that trade, because it negates where your ranges are set up and how that play you anticipated that play to go. So we're going to get over to the live example. I've got a great one to show you guys. We'll just get it going. Just give me 1 second. I just got to switch over. Still on screen, Zach?
Yes, sir.
All right, perfect. So this is the Webull. This is the desktop platform. This is the chart of Best Buy. Reason I picked Best Buy is because retail has been getting hit all of last week. We had a great XRT play in our group, and we know that Best Buy earnings are coming up. And this is really going to tell you how the consumer is on far of excess cash, because Best Buy really deals with technology, computers, TVs, Xboxes. And we see when the economy is slowing down that people tend to shy away from those bigger purchases or those new purchases. So we're just going to chart this out, and I'll show you a couple of things that I've learned and what Zach's taught me as well. We'll use it iTrends. So we'll get started. So whenever you're charting a play, this is the chart of Best Buy. I'm currently on the weekly. I'm going to take at the monthly just to look at the highs. We can see that this wick pushes out. So we're going to tighten in on that trade. And we're looking at where that's going to consolidate towards the bottom side. So what I'm going to do is I'm going to take the horizontal line, and I'm just going to look where it's going to kind of level out in this first range. So I'm going to drop a line here just because you can see if we're looking to the left, you can see where's the consolidation. It happens right here. These wicks we ignore when we're going to chart just because these are big pushes in volume that never really settled out when the candle closed. Looking through that, you can see, look where this all hit. Look where we can draw a common ground towards the bottom side. So we can even tighten this up. And then we're going to start large and then move in. What does that mean? You start on your monthly and you move down. This is just charting your trade if you have no lines on the chart whatsoever. The great thing about trading is that as you get moving forward and as you go on, you'll have not only these support lines, but you'll have historical supports. And what I mean by that, and I could show you, is that I trade Disney, and everybody in the group knows I trade Disney every day. These lines I don't move, these trend lines, these are plays that I've seen where Disney moves all through that. And the best thing about any platform, it'll save your lines. So, that way when you're flipping through or you come back to this stock that you haven't traded in a while, it'll be right there and the lines will still be there. So we're going to move back to Best Buy. So here we are on the chart. We're going to draw this tops level. We're going to move into the weekly so we can get a better picture of where it's at. We're going to scroll out and we're going to draw right here. We're going to draw right about here towards this top side where this wick finishes out right here, just to mark as our top side. For me, I ignore the wicks when we're coming with all-time highs, knowing that when we were on the weekly chart, on the monthly chart, this was our all-time high. I ignore that outer wick because there's not confirmation. I know at least where these bodies are finishing up, that the buyers, the buyers pushed it up, the sellers rejected again, and then it reversed the other way. So they couldn't confirm above this line. So that's where I'm going to draw the first line, is right here. Second line is going to come in. We're going to look a little farther out so we can get a better picture. We'll go to draw another line, and we're going to tag it in. Right about here. And the reason I did that is because I wanted to see where this gap kind of ladders up, where this little resistance spot is. And if you screen back, this is where that first resistance hit way back here. So you see on the first movement, this is where it hit the top side. And so that's where I got this line right here. You can see that the buyers and sellers bounce back and forth all the way through this level. And we could tighten it up when we move into a closer time frame. Now, if we're looking more towards that downside, we want to get a bottom range of these levels right here, just as we're moving forward. So take my line, and we're going to come right here where this candle is, right here where these little bottoms are. And we're going to snap this right. Sorry. We'll say right about here. And the reason I did that is because I'm watching right here coming through where it finally rejected right here, where the sellers kind of lost control. They push it down once. Buyers try to step in. Couldn't make it back. And we'll leave this line right here and we'll tighten it up as we're moving forward. So then we're going to draw a couple more lines and then we're going to zoom in to really find our play as far as coming into next week. Because earning is, I believe, Tuesday. So the reason I drove right here, you can see right here where we had a couple of our bottoms come in. We see right where it's rejected right there. And previous, where was our old resistance level? Slide left, you can see it's right here. Came pushing up before it pushed all the way past. So then we're going to go 2 more lines or 3 more lines here. We really want to focus on this trade coming in as we're moving this way. So as you see, we're going to keep moving forward. I'm just going to finish out the lines and then I'm going to zoom in and we'll show you a little more towards the bottom. All right. So this is kind of where we have our general ranges set up. This is just coming in on a weekly play. Now we are looking at an earnings play, and on an earnings play, you want to stay close to the week just because these earnings have been pretty drastic. And so that's why we got to move in, tighten our lines up a little bit, and then we'll look at where we can enter and exit based off this trade. So that's where we bottom out as of Friday. You can see this is where it load coming into Friday. This is where your high is up here. You can see this is where we high before this next range came in on this chart. You can see if we're looking at these top candles, where we're looking at if we push higher, coming over these candle bodies right here, pushing lower, we definitely want to see a break. But if we're finding it, we want to find a near-term bottom, because if we're playing retail towards the downside, we really want to secure in where we're looking at towards that bottom side. And if you look back, like we said, look left, you see a lot of consolidation right here. So we're going to keep that as the bottom. For me personally, if I'm looking at this trade, something you also want to do is mark where you have your gaps. So what I like to do is, because like we said, all gaps tend to fill themselves. So I'm going to draw this just because I have a little gap here, just so I know that that gap eventually has to fill themselves. Not necessarily right now, but all gaps do fill themselves at certain periods of time. So we're going to draw that right there. Now, looking at this chart, we can move in and move in. You can see how we have perfect, what we call ranges. What we call ranges are these little boxes. You can color them up if you want to. You can set tighter goals if you'd like to as well. And you'll see me do that when I'm looking at my trade just for the week. So we're on this 4 hour right here. Now we're going to go to step 3. We're going to set our entry and exit points for what we're looking at on this play. So if I'm watching just this near time action, if we're looking towards that top side, I'm going to have to see a break right here where we started off, just to move it towards that high side. Because I need the buyers to gain control and push it over this little near-term line. So I'm going to change it to a different color just so I know that this is what I'm referring to. And we're going to put that right there at that 73, about 73 and a quarter. And we're going to go a little higher. I want 2 up just because we're going to mark our outside contracts as well. That's something really important to do. So we're going to do that right now. Right there. And then now we're going to watch this bottom side. I really want to see where these levels are lined up and where we should. Now, obviously, if we're looking at this chart, we should pull this line down just a hair, just because we're really tight in. We really want to find that perfect little sweet spot. To be about right there. All right, and if we're looking downside, we're going to have to actually tighten in, just because it does look a little bit choppy. You can see a little bit of support came in right here at 72. So I'm going to mark that right here at the 72 level, just to know that we need to push below that at least before we enter our play. That way, it looks right now that the buyer's here. Now the candle is red. That means that the sellers can control, but the wick is so small that it's almost, you can ignore it just because it's pretty neutral right where it's sitting at. And then we're going to mark one more down towards that bottom side, just so we have something towards the bottom. And honestly, we're going to mark this 70 level just because it is key. By moving tighter on this 30-minute, you can see pushing back. You have a little cup and handle here, which we'll go over later. But at that 70 level, it's not only a mental level, but it's something important. And ultimately, we're looking for that 69 break. So just looking at this, the step 4, which is really important, is to check your work. So we're going to go all the way out, and something I like to use is the Fibonacci retracement. So we're going to pull that up right now. And for that Fibonacci retracement, what I like to do is not, like I said, ignore this top wick because that's something I don't follow. And we're going to retrace back. If this stock were to come down, how far can it come down? So what you have to do is you have to click that Fibonacci retracement, click right here where you're at, zoom out, try to mark your full move. So we're going to mark it. And we'll change the color. That way you guys can see the difference. And let's take a look how we did. So just by our charting, look where our lines hit. Our lines are the teal, and look where the blue is. The blue lines up right where we're looking at. So that's a confirmation. That means where you're marking your support and your resistance levels are spot on. You can tell by the way this hits, that's something you want. And that's something with time and practice, 12 years for me, that's something that you can ask anybody in our group. It's something I excel on. But that's just one tool you can use to check your work, because the Fibonacci retracement, it's a mathematical formula that creates a pullback. And what most stocks retrace or fall back to. So if traders focus on that 61, they focus on here in the 38. And then if it extends all the way towards the bottom, it's pretty much ignored. Another thing, when you're checking your work, you can use different indicators. For me, I use the Vortex indicator when looking at a longer out trade. And I also look at the RSI. So the RSI, that's going to be your, your volume, which your volume is here. Your Vortex indicator is on top, and you have RSI here. Now, RSI is important because when a stock hits 30, that means it's oversold. And when a stock tends to go to 70, that means it's overbought. As you can see on Best Buy, when we're hitting this oversold level, that you can see a bounce. So that's something we have to take into effect, but retail is really weak. So that's something we can ignore it on. Now with your Vortex indicator, this is talking about the likelihood of a move going forward and how long it will take. So this orange line is going to be negative here, and then purple is positive. Now, when either one's showing towards the top side, that means that it's in control. So you can see that the trend is pushing down. We're in a bear market. So that orange line is in control as of now. It does change on your time frames, may look a little different, and so does the RSI. But you can see that it's already pushing down. It's already extending. It would take several days for this trend to reverse, and you would see these lines cross back over. You would see the RSI turn on the bottom side as well. So just by doing that, that's ways you confirm your trade. And now that we have our level set, we're going to go ahead and look at contracts. And I'm going to show you guys actually how to find contracts like Zach was talking about. So like he showed on the previous slide, just let me get down here. This is the table Zach was showing you guys earlier. So this is the Webull's option table. And we're going to look at, based off our trades, what we think is the most predictable move. So like you saw up here, we had a break of 70 here. We had a key level at that 69. So if we're looking on that downside, we're going to look at that 70 level, and we're going to look at a lower strike somewhere in between that 69 and that 48. We're going to look for volume, most likely around like a 65 is going to be a key level, just because most institutions stays on the 5. Like Zach said, those weirder numbers in between, they kind of shy away from, and you'll see them added in. So that's 65 or the 70, and vice versa. If we get up higher, we can also look at a 75 because we have our top side at 74, and we have that gap to fill at 80. So we're definitely going to take a look and see if traders are loading up in this higher zone as well to take that move. So like we said, it's an earnings play, mostly with earnings and how they've been performing recently. You can even run a straddle. You could pick 2 strikes. You could pick a put and a call. Or if we have our confirmation towards a bearish movement, then we're going to be looking just towards that put side. So if I come down to the option chain, you can see, what did I say? The 70 puts for weeklies, you're looking at 900 volume, about 500 open interest. If we look towards the money, you can see that this has higher volume, and it is expensive, but it's not as expensive playing right at the money. If you right at the money, those contracts definitely, they cost more, and the IV and the Greeks really affect that price and can significantly make those more volatile. So we're also going to look at our lower strike. Where is at our lower strike? Look at our volume here. We have 65s. You have 2,000 volume, and that's right at our break point. So we're going to mark those 2 trades down in our notebook. So if you have a notebook out, write your 65 put for 5/27, because this is the day, or this is the week we're trading on. And you're going to write down your 70 put and your 65 put. And then for each of those trades, we've already marked on our chart where we want to enter. That being said, for your 70 puts, you're going to wait for this to break back under this 72 level. So once this confirms under, and you see at least 2 or 3 candles confirm underneath that 72 level, that's where you're going to enter your 70 put. Now for a strike that we need to go all the way down to 65, so we need some significant movement, we're going to watch it break that key level of 70, or you could wait for even more confirmation where it breaks the low at that 69, and vice versa. So we're going to look at the top side now. So we'll go back to the option trade. We're going to come down, and we're going to look at where's our top side. So you can see volume is going to be sitting there at your 75, which you can see there. You have 515, which is the most towards the top side. And if you go even farther out, look at this. On the 80, where the gap is, you have 5,000 open interest, or 5,300. You have 900 volume. And that's where the gap was to fill. We saw and we marked. So we're going to mark those 2 strikes down. And like I said, you already have your top side where your entry points are. We've already gone over that. It's going to be right there at your 73 and a quarter and a break over this top side at 74, or you can wait for 75 to go even higher up. Now, like I said before, I was going to show you guys when I was talking about OPEX strikes. If you look on Webull, and it has it on TOS as well, this week strike is going to be week by week. If it's an OPEX or a monthly expiry, you're going to see just the date. So this June 17th is just the date that you have on there. And we can even look at our strikes. Look at 60. If you look at the 65s going into the next OPEX, you can see a ton of volume came in. Now the 55s are lower, but look, they have more time for that movement to happen. We're trying to capture that short gap on that weekly, and there's volume still out here at the 65s and at your 70s. So you know the strikes you picked in May, the institutions are agreeing with you when it comes to that level. And we'll check the top side just because. You have 75, not as much, but when you get to the 80s, you have a little more. But with this bearish market, you can tell you have them all the way up into the 90s. You could tell that not a lot of people are trying to pick this call side just because how weak retail has been in general. That being said, if I was playing in one way and just reading the chart, we're not going to fight the trend. We're not fighting the trend. So when we're looking at the trade, I would play this towards the downside when it comes to earning, just because the consumer doesn't have extra money to spend on electronics. So I tended to go towards the bearish side, but you could either play the strangle, go either way to protect yourself on both, or just go with the put side as long as it breaks through and confirms underneath the levels. Something else I like to tell people to look is look at the sector ETF. So if you remember from yesterday, that's going to be your basket. You want to look at that just to see how that's trending as well. So the retail sector is going to be XRT. XRT is your Spider Retail ETF, and this owns 0.59% of Best Buy. So if we go out to that larger time frame on here, you can already see we're in a downtrend. We've been in a downtrend, and this gets tighter as the weeks move in. You can tell we haven't broken our key levels. So this is something I want to pay attention to at our bottom side here. You want to look at where that is, where this consolidation kind of happened at, and where we can look at. So I already have this charted out. I actually traded XRT with the group. But if we're looking going forward and we're going to continue this bear trend down, we can mark even below or here just to see if this is going to hold as well. So with any trend line, you can extend it just by clicking it and pulling it down, and you can keep extending your trend line and watching it go. And this just means a trend line is the direction the stock's moving and the price it has to push over to confirm over what the downtrend is. So we'll zoom in. You can see on the weekly, we're still in a bearish. You saw a large push, but we have confirmation still pushing towards this downside. So that's where I'm going to find my confirmation, not only on the basket, but as well the stock itself. Now, if you didn't want to play Best Buy just itself, you wanted to go play an ETF like this, and you're still in that bearish move. When you're talking about an ETF, most institutions load ETFs. So you want to focus on that OPEX date. And we're still in a bearish trend. I think that with the most of the positions and the stocks that are coming up in the earnings are going to confirm that we're in a bearish downtrend. We look at this next OPEX and we're going to see where that volume is. You got them on the 50. You have them at the 55, barely any there. You also have them heavy on the 57, and you have them higher up. That being said, we're going to look at the chart. We're going to look at where we're at. For me personally, that next level is sitting at 55. I don't like sitting right on the strike. I like to have a couple dollars where I think it's going to move to. I like to be a couple dollars higher. So if I'm looking at a bearish trend on XRT, I know there's a lot of volume here, a little pricey. I'm going to move towards the middle. I would go right here at this strike. I know there's a lot of volume here. You can go with the 58s or the 57s. But for me personally, we've already pushed down significantly on XRT. And I think that'd be a contract that would be optimal. And that you have to be careful because remember what we said, this spread, ridiculous. So you would definitely have to hunt the fill, but you have over a month out. So you have plenty of time to hunt that fill, hone in on your position. So you can play Best Buy, try to get a good fill on your ETF. Best Buy plays out bearish, and then you let your ETF run because you have months on that to do that. And you already know, the direction of where retail is going based off the earnings that you played. So I'm going to switch back over to right here to the slideshow, and I'm going to show you step 4 just as it is on our slide. So what did I show you? I use the vortex indicator, I use the RSI, the fib retracement, and sometimes I'll use the cloud. But this is just ways you can check your work. Now, when it comes to indicators or it comes to patterns, something I have to say is you should really master your support and resistance lines, because when you get those down, you use these indicators in these patterns as confirmation, meaning that you want to get really good at looking at a chart, snapping on support and resistance lines quickly, because trades do tend to move, and then turning those indicators or those patterns on and letting those confirm. Because if you chart something out and then all of a sudden, you put that retracement on, it hits every level, you're like, okay, well, I can go to the next chart. Or during the day, if I'm looking for a scalp trade, I know that I have my support and resistance lines down, and then you could just expand. And each, there's hundreds of indicators, there's a bunch of patterns as well. And we have a book that actually goes into detail over each one. So definitely take a look if you want on our website with that ebook. Like we said, we'll give away some at the end, spend a lot of time on it, but just nail your support and resistance lines, and it'll take you really far in trading. With that being said, I'm going to kick it back to Zach, and he's going to go over some general market structure for you.
What up? What up? There we go. I got you. Apparently, I can snag it back from you. Somehow,
That's fine.
I can just steal it.
It let me steal it from you, so.
They call it reclaiming. Yeah.
Oh, is it?
Yes. So on the indicator slide, here you go for it as well. There you go on the indicator slide. So Tico asked a question about what causes the gaps and what does it mean by having to fill back. So what causes gaps is in your close movement, or really anytime, but it's irregular on a liquid stock, on a stock with volume. It's irregular that you're going to see a gap during the day, during the actual trading hours, 9:30 to 4, because there's lots of people trading, right? So the values at which the stock are trading, there are people that are filling at those values actually, right? So over pre-market and post-market, you'll see lots of different gaps happen because there's less traders. So if a stock is at $75 and somebody wants to buy it at 75.25, but there's nobody in between there, it might just gap up 25 cents rather than doing the whole 25-cent movement until that person gets filled at 25 cents. So when you see a big gap like that, it's because a lot of orders came in at a specific price and there was nobody in between. So the next day when somebody got filled, it was at that price that they had. So in that specific example, it was, 82 to like 79 or whatever. So there was a $3 difference there where nobody had any orders, and the next order to get filled was at 79. So like that's where the gap occurred. And in the whole saying of gaps always fill themselves. So first of all, price action, candlesticks in general, all of this comes from the Japanese. The actually very first charts that were ever traded, the very first products that were ever traded and charts that were ever used were from old Japanese days. It was the rice futures trades. That was the very first market ever that was tradable, the rice futures. So when you go back in time, you'll see that the Japanese are really the pioneers of price action and candlesticks specifically. In the West, over here in the West and the US, we didn't use candlestick charts until literally like 1970s, I think it was, or maybe the 80s. This guy named Steve Neeson really made it a popular thing to trade on candlesticks because it shows you so much more information. If you've ever seen a bar chart from like a really old trader, like an 80-year-old trader, and they got the bar chart and it looks like little weird, you got one little line and you got a bar up and you got another line. That's called a bar chart. And that's what the West used for a long, long time up until about the 70s. And then Steve Neeson introduced candlesticks from Japan. And then that's when we started adopting that. And now, obviously, that's the most used style of charting now. So to answer your question about the whole gapping, there is in the Japanese literature, they coined that a gap will likely, there's no percentage that they state, but you can read the book and you can look back and check. Trust me, I've read the Steve Neeson book. And you can see that the Japanese say that they call them windows. We call them gaps in the US, right? In the West. So the gaps or the windows, they will fill themselves as time goes on. However, if they do not fill themselves in 3 days, so that they do not fill themselves within 3 days, it's more likely that it'll take a significant period of time for them to fill themselves than not. However, you will see more often than not, those gaps get filled in 3 days. Now, gaps really don't occur on stock graphs too much. Like nowadays, you see them a lot because there's lots of volume, etc. But in the whole realm of trading, in the different markets, realistically speaking, you see way more gaps on commodities, futures products, products that are a little less liquid, higher value of the actual product that you're trading. $1,500, like an Amazon, $1,500, or Nasdaq right now, $11,000. You see a lot of gaps on futures products. You see a lot of gaps on commodities. In the stock market, you see less gaps. So anyway, that's the rule. If a gap doesn't fill itself in 3 days, then it's more likely going to take a long period of time. We can talk about gaps here in a second. So anyway, hopefully you guys, you wrote that down on the indicators tab. So right now we're going to talk about patterns, trend lines. We're going to go into trading view. We're going to go into support and resistance, supply and demand zone, and we'll talk about gaps as well. So these are some patterns that you guys should be aware of. This is our cheat sheet that we created, and it houses some of the patterns that you heard Spencer mention, the W&M patterns and the bull bear flags, bull and bear pennants, right? So you can see here on the left, this is just a really quick cheat sheet, just little look over, right? So we're looking at reversal patterns. What does a reversal mean? Quick quiz. What does a reversal mean? Quick quiz. Just a couple answers in the chat. What does a reversal mean? A reversal of price. What does that mean? It's when a price hits A and then goes to, oh, Lauren. Oh, change of character. See, that's a great way to put it. That's amazing. Yes, change of character and stock price. I'm not going to wait for you guys to answer. I think you get the point. It's a reversal in price. So a stock is trending up and then it hits a certain period, the resistance, there's certain price, the resistance, and then reverses thereafter. Or you have a continuation pattern where the stock rallies, hits that point, and then continues from thereafter, right? So it wouldn't make sense if the stock is continuing if it is pulling back after hitting a price level. So if we look back in the reversal patterns, you have specific patterns that indicate reversals. That would mean that when you're at a top of a trend or a bottom of a trend, it indicates that a price is reversing off the bottoms or reversing off the tops. So one of those patterns that we can take a look at here is the head and shoulders, right? So you can see that we're clearly making highs on the stock here. So we make a head and shoulders pattern, head, shoulders, right? So this is the head right here where you have the top peak, and then you have two lower highs on the left and right side. And then once you break the neckline, this is called the neckline here, a support, right? We've come up, pushed up, broken this resistance. Now it's an old resistance is a new support, bounce, demand, bunch of buyers come in, push it up to make a new high. Sellers come in, pull the price back down to that support again. Buyers push it up, but they get rejected here at this resistance, previous resistance. And then the stock pushes down or pulls back down through that support. That's your entry. That's called a head and shoulders. That's showing you that the price is likely to reverse from that. That trend is likely to reverse, right? So the inverse of that would be called an inverse head and shoulders, where it's just like being upside down. So head, shoulders, upside down. But this is just showing you that the trend is reversing from a downtrend to an uptrend. And then moving down, these are my personal favorite. And I could talk a million years about W&M patterns. There's also a video on our website, kind of crappy audio, but goes really well in depth on it. Not website, but YouTube, excuse me. So the W&M patterns are amazing patterns to trade in the market. If you study them close enough and deep enough, you will find that the market trades in W&M patterns. Weird, wacky W here, weird, wacky M here. It goes in through a lot of deep theories that I'm not going to get into right now because, like I said, I could talk about it for hours, but we want to get to the charting. So anyway, an M pattern is when you're in an uptrend, break through the resistance, come back down to form the middle of the M at a support, bounce off of it, buyers step in, push the price back up, and then sellers come in at that rejection level, bring the stock down. You've got your neckline, you break that neckline down, and now you're reversing the trend. So there is a short opportunity there where you can trade the stock short. Now, some of you might be looking at this and be like, wait a second, this is a double top. This is a double top right here. And then the W pattern is just double bottom, right? So here's one very big misconception that is understandably misunderstood because there's so many people talking about all different types of things on the internet. But a double top and a double bottom are not patterns that you trade off of when you hit your second double top or when you hit your second double bottom. The true entry on a double top is after you break the neckline. The true entry on a double bottom is when you break the neckline. So in other words, you're not trading a double top, you're trading an M pattern. You're trading not a double bottom, but a W pattern. So that's really, really important because definitely newer traders are like, oh, I've heard of the double tops. This is a double top pattern. Oh, this is a double bottom pattern. Should we take the trade? It's double bottom. It's at that same support. You don't have any confirmation there. Yeah, there might be a slight bounce and you might catch it 3 times out of 10, but that's a 30%. And that's really not what I'm looking for a success rate here. The success rate jumps up to 85, 90% when you wait for the break of the neckline, have your confirmation, and then it continues thereafter. So that is the true way to trade a double bottom or a double top. And that is really important to know because it's, again, misunderstood. And a lot of people portray it as you just take it as soon as it hits that same support level on a double bottom, you take that trade, which is just not the case. If you want a really risky trade, absolutely. So anyway, let's go on to the continuation patterns here. Bear flag, very simple to imagine, right? Think of a flagpole, right? You have the pole and then you have the sideways flag. And then just imagine another pole extension beyond that. That's a bear flag, or that's a bull flag, excuse me. And then the inverse of that would be the bear flag. So that's when you have a drop in price, the consolidation, and then a drop. If you remember from yesterday, that's one of the ways the market moves in, right? Drop, base, drop, right? Or you have, this is mind-blowing time, right? Drop, base, rally. Those are the way that the market moves. 2 different ways. It's one or the other. So here we have the bull flag where you have a rally and then a base and then a rally. Then we look at the M pattern over here. You have a rally, a base, and a drop. And so these are how the market moves. So for me personally, I trade W&M patterns all day long. I love to trade flag patterns. They have a high probability. But realistically speaking, they're not going to look this perfect. So we have to be able to identify this. So we're going to go into TradingView in a second here and learn how to identify these. Another version of the flag is when it's a little bit more concise and it comes to an apex, right? So an apex is when 2 points come together. So this apex right here is a pennant. That's what we call that. So the price isn't perfectly lateral like this. It just comes nice to a concise apex where the price explosively breaks to the downside. So it's really, really important to understand and recognize, rather not even, well, understand as well, but recognize these when you're trading because these patterns show up time and time again. Cup and handle is something that I'm sure that all of you have heard of. It's a little bit more difficult of a pattern to trade because the cup and measuring the handle can be a little difficult for newer traders. Generally speaking, that doesn't affect the probability of it, but it's just a little bit more difficult to identify, right? So therefore, I look and identify cup and handle patterns for me personally, but it's not like I'm looking for them to trade. I'm looking for W&M patterns to trade because it's just a rally-based drop or a drop-based rally. Very simple, reversal trading or continuation, rally, drop-based drop, rally-based drop. Rally-based rally, excuse me. So let's move to TradingView and let's just try and find some patterns here. So let's pick a stock. Didn't plan any of this out. Actually, somebody drop a stock. Let's just pick a random stock. Somebody put a ticker in the chat, please. No, Spencer, I'm not looking at Disney. I don't want to look at Disney. QQQ. Okay, keep dropping some tickers and we'll just go down the line. So we'll start with QQQ, then we'll do Disney, and then if somebody else wants to put a ticker in there or a company, just put the name of the company and we'll take a look at it. So I can see one right here. It's right at the top, right at the tippy top. You know what we're going for right here. Boom. All right, here's the top right here. Here's a support, right? It's currently basing consolidation, right? Bounce off that support again, made another top, and then boom. So that would be this is the perfect version. This is the real life version. So there's a little bit of a drastic difference there. This is also a very large time frame, right? So if you're waiting to trade this M pattern, you're going to be waiting for a significant period of time, like months, right? So there are patterns that are viable on shorter time frames. An M and W pattern is absolutely viable on shorter time frames. So we're going to go down further into this specific. Let's just mark this so we can find this. Let's go into this specific time frame here. Let's get rid of this M pattern that we just found here. And then let's zoom in. Let's go to the 1 hour. excuse me, 1 hour. And then let's just take a look at this. Okay, so this is a long period of time, but now you drop down and you can really see a lot more that's going on in here, right? You see a lot of price. Let's expand it a little bit so we can see it a little bit better. You see a lot of W and M patterns inside of this bigger M pattern right here. So one that's easy to point out here is all the way on the left. We're going to take a look at the W pattern, and the W pattern is bullish, right? You break the neckline, it's bullish. So this is actually close to the perfect rendition of the W that we just looked at right here. But you see, nice little W. Where would you take your neckline? It's right at that middle resistance that the price met after rebounding off of demand here, off of support, came, found resistance, pulled back, formed a higher low, right? This is your low, this is your higher low. And then once it rebroke, kind of fiddled in this area, consolidated, and then continued to push back up to this extension here. Now, we're not going to talk about the laws too much here because, again, we could spend a lot of time talking about the laws. The main point here is being able to identify these, right? So let's just take some text here. This is your higher low. This is your low that you want to pay attention to. Oh, no. We don't want to go to lows. Not yet. Not if we want to break the bank. Freaking inflation. Low, higher low, right? And we have our neckline right here. Neckline, you could call it resistance, but technically the actual term here is neckline. Let's make that a little bit smaller. All right, perfect. So you have first price declining. If we look to the left, let's zoom out a little bit. Okay, we have demand where buyers stepped into QQQ to push the price back up. If we look to the left, there's demand in this area, right? We hit resistance, then we pulled back a little bit and finally broke through. Took us a little bit, about a month later, or maybe 15, 20 days or so, we came back to this level. It's just about there, which this is where you get into identifying zones. You have zones of resistance and support, and we're going to get into that in a little bit. So this low is confirmed on the left side here. Look left. Okay, yep, there's a resistance right here. Now it was used as support, coming over here. That makes a lot of sense why buyers stepped in there. So that's your low in here. After the buyers stepped in, we pushed up and we created a neckline of resistance. If we look to the left, big gap, big resistance here, right? It was used as support right here as well. Let's keep looking left. Let's see what we can find here. Big resistance over here. Remember Spencer had that one tidbit that he was talking about Best Buy? And he said that before the stock went explosive, he looked for that first high where it made that first high. It had that first extension, made that high, pulled back a little bit. And then ever since it broke that extension, it just kept going up right here. This is that first extension it had before it started moving its large uptrend, right? Before it started seriously extending itself from this 465 area to the 410, right? So this makes a lot of sense, right? Why the sellers stepped in at this level, pushed the stock or pulled the stock back down, creating that higher low. And then once you rebroke that resistance, once the buyers had enough confidence to break that resistance, that's how you know you had your confirmation to then take the trade up to the next extension. What I look at W&M patterns, and there's 16 different types of W&M patterns, and really I focus on 5 to 6 on W&M on both the W side and the M pattern, because the other ones are less probable and I ignore them because they're less probable. So when the rule of a W pattern is that this first extension down, you take this first extension or take a look at this first extension down. We create that low. Let's just take a measurement here. From that low up to the neckline. So that's going to be 4.35%. And then according to the law of W&M patterns, after you take that extension, you then take this and put it above the neckline, extend it beyond the neckline, and that is theoretically where you should see the stock extend to after you break that neckline. That is technically law. So if we think about it, if it's technically law for it to be a 1-to-1, it was a 4 point. Why did this differ? I literally just grabbed this from here. Okay, we're gonna make it 4.37. I just duplicated it. I don't know why it didn't. 4.38, close enough. So if it's technically 1-to-1, right? It should be 1-to-1. So we're going to be looking for 1-to-1. If it is less than 1-to-1, then therefore you can assume that pattern, that the buying pressure is actually a little bit weaker than it should be. And if it's above that 1-to-1, so in this case, if it's above 4.35%, then you can assume that buying pressure is actually a little bit stronger than it should have been, right? So you can see here that this left leg, if you want to call it leg, this left leg pulled back down. We had that 4.35% extension up. You measure the same extension up here. You had your first extension before a pullback at this 377 level, which is, let's see exactly, probably around 4% or 3.8 or something. Okay, 3.2%. And then you didn't really hit your 4.38% until here. We get rid of this again. That's pretty much in line with this extension that we measured here before you hit another resistance point. So that's something to keep in mind. Let's reel it back a little bit. Let's just keep identifying some patterns here. So we have one W right here. We have a little bit of a messed up M pattern right here. Like you're not looking to trade that. A little bit of an M pattern here as well. Let's see what else. We've got a nice little M pattern here with a small neckline. So I love these patterns right here. When it has a really concise, the extension between the neckline and the top of the highs on the M or the bottom of the lows on the W is nice and concise. I love that because those moves can be really explosive. If you remember, rally-based drop or drop-based rally. That's those types of patterns right there. Let's take our trend line. Let's mark just briefly the neckline here. We have our nice M pattern. Extension down. I actually made it way lower over here, right? So I love patterns like this because you have excessive pullbacks or pushes, in this case, a pullback in price once you break these necklines because you've been consolidating. So if you think about it, that tug of war is going on and the buyers are slowly and slowly getting exhausted and they're just slowly and slowly losing the fight. And then they finally lose the fight and the sellers take control and break the stock down, right? And here's another good example as well of break and retest. You have literally a perfect break and retest here, right? So we have the first initial break of the neckline, then we came up to retest, and then the buyers failed to push it back above the neckline, the sellers gain control, and now you're down again. So there's that break, retest, and then come down, right? So let's just move forward. Let's keep identifying some of these patterns here. To move forward here. This is a failed W, right? I want to talk about this really quickly. Failed W, right? If it was a correct W, it would have broke the neckline here and then started trending up. But what did it do? It came down. So what could you say this would be? If it's a failed W, it actually just turns into, I can command copy this. It actually just turns into a bear flag. Hopefully that makes sense, right? Does that make sense to everybody?
Yep.
Awesome. So if you have a failed W, it turns into a bear flag. If you have a failed M pattern, right? If this M pattern right here failed, think about this. This is like almost a textbook flag that just forgot to play out and played out as an M pattern here. And you would have had that extension up. That would have just been that bull flag. So hopefully that's making a lot of sense here, how all these patterns kind of coincide and the direction of the break really determines what pattern is playing out. If it's an M pattern, it's going to have that rally base drop, but if the M pattern fails, it's going to have that rally base rally, and it's going to be that bull flag that you're expecting, that bullish, right? So it's really interesting how these patterns kind of all coincide here. I'm going to take that away, right? All right, so now let's drop down a little bit deeper, and let's focus on some smaller term ones that we're looking at here, because this is great. I mean, we're looking at, okay, this is a nice little W pattern that traded out here January 20th to Feb 2nd. Okay, so 12 days, not bad in here. Let's find a pattern that was like 5 days though. It's another like 12-day pattern. Nice. Trying to identify a little pattern here. It's a little bit longer than I'm looking for, but there are some good examples in here. One example of like a really weak little M pattern here is this, right? You had a drop down below the neckline, right? So this is mini, this is like a couple days. And so this right here is a little consolidation zone inside of a bear flag, which is just a small M pattern. So whichever way you want to think about it is if you think about it in the bear flag, you're trading the same neckline that you're breaking down from. If you're thinking about it as a small M pattern, you're trading the same neckline that you're breaking down from, but it has this nice explosive move because we just saw all this selling pressure, and then sellers were like, all right, let's chill a little bit. We're really taking QQQ down. We just took it down 18 points in like 4 days. Let's chill back. The buyers kind of step in. They don't have any leeway whatsoever, kind of like what we're seeing right now and what we've seen this entire time for the past 4 months. Buyers step in, no leeway, and then the sellers come right back in. They're like, all right, great, we got more orders to fill here, and then downside, so excessive downside. So let's take another stock here. Let's go to, you guys didn't put any in the chat. Let's just go to Disney, even though I really don't. Okay, Roblox, great. Roblox is much better.
Oh, they're
Let's
up there.
take
You
a
got to
look.
scroll up just a little bit. You got to scroll up just a little bit, Zach. I've got AMD, SPY, EA, and
Okay,
Apple.
great. All right. So let's
I'll type
take a look at, let's do less W&M patterns, even though that's what here's the W&M pattern. We got to do it. I literally trade W&M patterns all the time. That's the one I love to trade W&M patterns. So let's see, a little small M pattern here with a gap. Oh, I forgot to close it. With a gap, which is pretty interesting to see here, right? Nice little M pattern where you had the rally up base and then drop back down. You trade the neckline. So let's delete this so we can see it in here. Let's expand it a little bit. Let's go do a little funny dance here. Okay, so nice neckline, boom, even a perfect retest here. You have your extension up and you have your extension down. So trick question, where's your entry on this? Where is your entry on this M pattern play out that you're looking in this zone right here? You're looking for at the trade, you're identifying, okay, this is either going to be a bull flag and we're going to trade this consolidation to the upside once we break and confirm to the upside. But if we're not going to confirm to the upside, we're going to trade this break to the downside because this is really just an M pattern. Where is it? When it breaks the neckline down, Tico's got it. Neckline down, Polanco. Okay, perfect. So if you notice, we're talking about necklines, right? We want that confirmation. We don't want the one touch like a double top or a double bottom and the way that people say that you should trade those. We want the confirmation of the neckline. That's where you know you've got the actual continuation of that pattern, right? And of course, this is arbitrary. We've talked about it a lot, but you want to make sure that your stop losses are tight here, right? Of course, just with any trade, but you're looking for that break of the neckline. So let's continue. Let's go on to AMD. AMD, let me tell you about AMD. This thing is a range traded stock here for the past couple of weeks, but we've been banging it. Oh, look at this, just textbook W pattern here. Look at this. Nice. Form the neckline, come back down. Bam, that is like textbook neckline right there. This is why I love AMD. This is why we traded AMD every day of the week last week. So nice little neckline here. Big break. Once you had your neckline break, you had a nice extension. Granted, you did have a big extension pre. Don't know what day this was. This was the 13th. Okay. This was all of the 13th. We traded this. Actually, we traded on the 13th, AMD. Very nice trade. I think this was a 2 or 300% trade, but this was a banger. So anyway, very nice. And it's nice to note here that you had to break and then retest a few times here. This is the hourly, keep in mind. Break, retest a few times here, and then you had your further extension up. Now, what is this, that further extension? That's just a bull flag here. So as we can see, we take and just roughly put our resistance right here. You have your first extension up, and then you have your second extension thereafter. After you break the flag, the consolidation of the flag to the upside, there's another trade for you right there. Okay, so let's reel back. We looked at a couple patterns here. Hopefully that's making sense. So study on your own some different patterns that you like to trade for yourself. And really it comes down to each trader. You're of course only going to want to focus on the highly probable ones, which we go over in that book. Again, like Spence said, we're going to be giving a couple of those away. So some people will get some lucky great looks because we go very, very much so in depth on our favorite high probability patterns. But you're going to want to identify which ones you like to trade the most, whether it's head and shoulders, W&M patterns, you know, bear and bull flags, the pennants, the cup and handles. You're going to figure that out through time, which one you like to trade the most for your trading style. So let's reel back a little bit here. We're going to talk about how to actually identify your support and resistance. So let's go to
Zach, let me stop you 1 second. Will you pull up your Discord message? I actually took a look at EA and I found a textbook cup and handle. Essentially the picture.
textbook cup and handle.
I mean, The extension wasn't significant, but she's there.
Yeah. Let's see. What time frame was that? I couldn't see.
It's on the day chart.
Mm,
Day chart go to February 12th through, and it's actually it's a little longer. Then it goes through April and then extends up out.
kind of hard to see on the trading view for me personally. You're talking about 2021 here? Cup and handle pattern. Oh, you're saying right here? This
No, I
February,
said-
yeah, of 2020. Here you go. I see your cup and handle. So this
I
is
got a
what a real
2020
life cup and handle. Yeah,
Yeah,
I
if you
see
go
it
to
right here.
2020, if you go to 2021, February 12th, and then watch it just play out through April 15th.
April 15th here. Ah, I see your little extension here. I mean, there's a couple
See where
cup
I'm
and
at?
handles
Yeah,
right here
there's
as
a
well,
couple of
actually.
them, but yeah.
This is pretty this is pretty textbook, as in you have a very deep cup, a little bit of a handle here and a break extension. I see this one right off the bat here, which is not as textbook. You kind of have a little bit more consolidation here. Again, why I don't really look for cup and handles, because it gets a little not combobulated, but I'm looking for a word. Anyway, it gets a little consolidation, like the consolidation gets a little wacky, and I personally don't like to trade cup and handles, or I take advantage of them, but I don't really look for them that much. But here we go. I see this little cup and handle here where you had this consolidation period, nice little dip, and then you had an upward slanting handle showing a lot of buyer strength, right? And then once you had your break of this resistance, you had a nice push up and very large continuation at that from 123 to basically the 150 mark. So that's nice to see. So let's go into how to actually identify support and resistances and what it's like to actually look for trend lines and what constitutes a trend line, et cetera, et cetera. So let's go to let's go back to AMD, because there's a little bit easier to identify on a range trading stock. So let's bring it down to the 4-hour here. And so for trend lines, you're going to want to make sure, and this might go past a little bit because we're already at 10 here, but I have a couple subjects to talk about. I'll go through them quick, maybe 15 minutes. So trend lines, we want to make sure that we are paying attention to a few things here. So what is a trend line going to consist of? A trend line is going to consist of minimum 2 touches, right? And they have to touch on the same level, right? So it has to be the same level, and they can be horizontal, or I don't want to say vertical, but diagonal. They could be diagonal or horizontal. So a trend line has to have 2 touches. So that means that when you're drawing your trend line, you have to have it come across, and the price has to touch it, not just once, but twice. Then you have a confirmation of, oh, okay, this is a trend line. This is a support line, or in this case right here that we just drew, this is a resistance level, right? And so therefore it has to be at the same level. And then also it's going to either be horizontal, or sometimes you can have that diagonal trend line down or diagonal trend line up, etc. Sometimes they're really skewed, like we just saw with that cup and handle where they're like this, and you see a couple of them like that, right? So they can take different shapes and forms, but they have to have that 2 touch. Okay, so let's bring AMD back, right? So that's the rules of trend lines right there. So write that down. So when we're looking for trend lines, just like Spencer said, just like I said yesterday, we're looking for the consolidation zones, right? Consolidation zones are where all the buyers and sellers are setting up for the explosive move after your consolidation, right? So if you notice here, we have a period of consolidation. So we just talked about them being horizontal and diagonal, right? Let's see here, 1, 2, 3. Let's see what that looks like when we line the trend line up. 1 touch, 2 touch. Okay, it kind of comes through on the third one here. Personally, I'm gonna say 2 things about this, right? 1, we have a valid trend line here. 1 touch, 2 touch. There was a 3rd touch, a little fake break, and then a real break above this trend line here, and then the price continued up here, right? The second thing I'm going to say is, for me personally, for my risk tolerance, I'm going to make sure that I take the higher tops and recognize that this was a fake break, only because it's going to make it a little bit more safe for me when I'm trading this. If I'm trading this diagonal trend line here, to trade above that resistance, to make sure that I'm not taking just another fake break. Because you'll see certain stocks have a lot of fake breaks. NEO is one of those stocks where there's tons of fake breaks above trend lines. But we successfully identified this trend line here. You can even see that once you extend it to this top resistance here, you get a break and then retest. The sellers failed to bring it back under. The buyers reclaimed and then we then went on a huge bull run from 105 to 160 here, right? So I want to point out a couple extra things here. One, I'm going to have you guys see if you can point it out for yourself. But me personally here as a trader, great. We identified this diagonal trend line. But for me, I'm going to look for a little bit extra confirmation. Your horizontal trend lines are going to prove to be a lot more strong than your diagonal ones because of the fake breaks, right? So your horizontal, I'm going to take this, bring it to the right here. We're going to take that, make it yellow. So bring it to the right, align this previous resistance with this previous resistance here. And I'm going to make sure that I take my trade above this horizontal level. Like, okay, I recognize that this diagonal trend line is here, and we just broke it. And now we're retesting, but I need my confirmation to be above this horizontal level, and then I'll take my trade up, right? And so after we take our entry here, let's just take, uh-oh, they pull it up in a different view. Where's the check? Okay. We take our entry right here, not red. Take our entry right here, right? And it's big. Take our entry right here. But now we have to identify for ourselves, okay, where's our take profit on this thing, right? Because obviously we don't know that the price went all the way up there. So let's just take this and move the price down here. That way get rid of all that price. That way it kind of cuts it all off for us. Okay, so now we're looking left. We have to look left. Where was the previous resistance where sellers came in and pulled the stock down? Well, that would be at this wick right here, right? And at this wick right here. So is the price going to hit this 114 first, or is it going to hit this 122 first? And I'm not asking you guys this. I don't want anybody to make a mistake on this. We're going to hit the 114 price before we get to 122. So we shouldn't be so enthusiastic about the price just rallying straight to 122 here. We want to recognize the potential resistance levels that we're going to meet before we get to that 122, right? So let's take a line and let's draw it at this 114 level. Spencer, you heard say that he's looking at the bodies of the candle. If you remember yesterday when we went over candlesticks, we talked about the wicks, top side and bottom side of the wicks. Those are your outbound ranges. But the real bodies tell you the true sentiment of the war that occurred during that candle. So right here, we're paying attention to the bodies. That's my personal preference. If you want to mark the wick up, mark the wick up. I'm going to use the body here. So I know that at this price level here, 112.80 is where my first take profit is going to be after we get a confirmation above this level, this 108.62. I'm going to be looking to take my first profits at 112.50. And then let's mark a couple extra, right? We don't really have too much resistance till that 122, but what's right here on the 4-hour? A gap. So we do want to pay attention to where the gap opened and where it closed, or excuse me, where it closed and then where it opened. So we're going to identify this level right here as well, bring it across, and then we're going to do the same for the resistance. So I might be really, really careful of price action once it gets into this zone, which is the next thing that we're going to get into. Once we get into this gap zone, I'm going to be really careful about price at that level. So hopefully this is making sense. We have our first take profit at this level, and it's going to be green, but we got to make it X because this is where we're exiting the position. That really makes sense. Then we're going to have our next take profit at this level here. And so if the price is coming up to this level and it's really just staying too long in here, I might be way more hesitant to wait for my position or wait for the stock in my position to hit this next level, because the more time we spend in here, the more the buyers are losing and losing and losing steam, and the potential of a reversal, or in other words, a rally-based drop after this breakout is becoming a potential truth, right? So the less time that it's going to spend there, the better for me personally as a trader. So as I'm going up, I'm using the iTrends forward one. Say we hit that 20% at this take profit level. I'm going to take off my 25% or my 1 of 4 contracts at that level. I'm going to wait for the stock to trade around there. It might push up a little bit to this range here. It might hit about 30, 40%. Okay, I'm going to take off that other 25%, that other contract. Now I've got half the position left. So I'm going to sit in here. I'm going to let the consolidation phase out, and I'm going to see how it trades out up to that secondary level. And then once it hits that secondary level, I'm going to say to myself, you know what, I'll be okay with taking the rest of my position there. After that being, let's take the measurement here. After that being a 7% move on the stock, I'm okay with taking that 7% move that netted you about 100%. On AMD, it's going to be like 100, 120%, maybe 80 on the low side. So I'm going to take all my position out there. I'm going to look away. I'm going to look to a different trade. So hopefully that makes sense, right? So that's how we identify our support and resistances as we're looking at a trade. So let's go back here and continue, right? Let's just continue going on. Tico, so the answer to that question is what I use to gauge if it's staying there for too long is I'm paying attention to how much the stock has moved on the day. So I wish we could just revert back, but let's just do this again. So let's say, okay, we're going to mark this back up. Crap, I shouldn't have deleted that. So we're going to have our first resistance level. We're going to have our secondary resistance level. This is going to be a little choppy here. I'm going to just try and do it quick. Good question, Tico. Boom. So this is quick. Okay. So let's see. So we had our first break of this level, traded up to our first resistance, and absolutely smashed the level above there. I'm going to bring this down to the body, excuse me. Smashed through, broke up towards our next take profit level, right? So if I'm on the day here, right? So this is October 13th, October 13th. This is overnight to the 14th, to the 14th, to the 14th, 15th, 15th, 15th. Okay. So if this is a swing trade for us, and I have time on it allotted, for me personally, looking at that level, I'm looking at the volume. So if the volume is decreasing and decreasing and decreasing, I'm getting a little less enthusiastic of being a buyer in that situation. I want to see the volume continue. So every time that the stock pulls up, the buyers continue on. Every time the stock pulls up, the buyers are just piling and piling in. And I'm looking for candlestick patterns. So a really strong candle, if you remember back to yesterday, is going to be one with little wick on the top side and little wick on the bottom side, if you get that, but big body, big buyer's candle. So you can see right here, this is a huge buying candle, right? Very big. It's very obvious that the buyers are quite enthusiastic, come right up to your level and then hits your resistance and then continues here. So I'm looking for candlesticks. I'm looking for buyer sentiment inside of the candlesticks. So I'm looking for big body, big body candlesticks, big body buyers inside of that candlestick because I'm bullish on the stock. I'm looking for volume and I'm making sure that we're not having harsh rejection. So like a harsh rejection, let's see if we can find, well, I mean, let's just look back to this resistance here, right? This resistance level, you can look to the left, big resistance level over here as well. And this was a harsh rejection. Like the stock didn't stay in here for more than a couple hours. So you're having a big harsh rejection of that level. Okay, so sellers are clearly present at that level. I don't need to be a buyer there. I need to potentially looking at actually bringing the stock back down or sitting hands on it. So hopefully that answers the question there. I missed that other question, that head and shoulders one. I'm sorry. Okay, so let's move on here. I know it's 10:07 here. Let's move on, and we're obviously going to go into this tomorrow. Tomorrow we go on actually how to identify the trades for myself and Spencer, etc. Let's go on to identifying zones, right? So every line that you draw as a resistance and a support is really just a zone of resistance and a zone of support. Your line might be super accurate, so the price might come up to that area and reject perfectly or come down to that area and bounce perfectly, but it's really a zone. So you have to get in the mindset of understanding that price is going to trade in zones, right? So price came up to this level, really harsh rejection, then started trading in this zone at the demand, and then started trading in this zone at the demand, failed, quickly came back above, started trading in this zone and then broke out. And then you have this explosive move, and then you're trading in a zone, and then you have explosive move. So that's how the market is moving, right? So we have to get in the mindset of identifying zones. If you notice here, this resistance 1, or really resistance 3, right? 1, 2, 3, and then resistance 4 is just creating a zone. So the stock is going to come into this area and trade inside of this area here, right? So break up to zone, break above, okay, and then we come back in here and consolidate a little bit of a zone in here, coincidentally where you rejected previously, and then you break above and continue on. So let's see what we need for a supply zone. All right, let's get rid of this. We need some, there we go. So we need some things that quantify a zone, right? Where supply, or demand. So we're looking for an area of consolidation, right? It can be resistance or support, right? And so we're easiest way to identify this is harsh rejections or bounces, right? So this is a couple criteria that you can look for when you're looking for your zones. Sometimes it's a little difficult starting out to actually identify your zones. So we did a class on this in our Discord like a few weeks ago. And a main way, easy way to identify where a zone is going to be placed is just really harsh rejections, because that means when the price returns to that level, it's going to be very difficult for whoever's in the party that's against it to get above there. So we could use this example, but we just use that example a lot there. So let's find another one. Okay, right here, found it very easily. We're looking for big harsh rejections, right? This is a huge rejection off of this level, big rejection. You had buyers push it all the way up and then sellers piled in. You can see the strength of this candle right here, right? Very large strength in this candle from the sellers, pulling it all the way back. We're looking for the V formation, V, right? And then you have a continuation, V. This is an upside down V, I get it. But V formation, upside down V formation, really hard rejection of that price level. If we look to the left, you have a really hard rejection of that price level, right? You have a really big support after the price pushed up to this level. You have a resistance that got put through like butter on this side. If you look to the left, really hard rejection of this price level over here. So it's clear that, okay, this when the stock returns to this level, it's a big level of demand when you're above it, and it's a big level of supply when you're below it. Or in other words, when you're above it, it's a big level of support, and then when you're below it, it's a big level of resistance. So let's mark that up. Let's identify that zone. Let's get out our zone on here, rectangle, and we can look left. Let's look to the left here. Let's identify where the bottom or the bodies had closed here. Take it. Okay, it's going to come across the wick of the top of this rejection, this really harsh rejection. And we're going to close it on the bodies on this level right here. So you can see that this is a really tight zone in which very harsh rejection, right? You have support that built up in this zone over here. You had a double touch. You had a wick down rejection of the supply zone, demand zone, excuse me. And then you had the sellers bring the stock all the way down through it. And then the buyers try to push back above. And then now it's used as resistance and then trending down. If we look to the right over here, big resistance. As we pushed up to it, buyers stepped in, attempted, but could not get it above the resistance or the supply zone. And then once you broke back through, it was used as support or demand zone to push back above. So we're just going to continue to identify our zones here. We're going to go in deeper on this tomorrow as well to kind of look for more of like actual trades like tomorrow. We're going to take these trades tomorrow, or we're going to take these trades the next day, etc. So let's keep identifying our zones here. Let's just identify the easy zone in which that AMD was trading in for a while here, all the way from January to this April, right? We're going to connect this wick on the left side here, extend up to the body and see where that goes across. Okay, so it's going to come across and touch this body on the side, right in this price area at this level, at this price level over here where demand stepped in, buyer stepped in and bounced the stock. Now it also happens to be a gap and a big level of resistance right here, and it's showing to be resistance as well over here. So make sure that we encompass the body of that first rejection over there. Okay, so now we have the zone, or the range rather, that this stock was trading in for like a few months. So theoretically speaking, when the stock approached this supply level, this resistance, you could have looked for shorts, look for that rejection, right? When the stock then came back down and the price receded down to this demand zone where the support is lying, you can see the bounces, big bounce, big bounce. So you are looking for calls at that area, so, or bullish position at that area. So it becomes a lot easier to identify zones, in my opinion, than just spot on resistance and support levels. You're going to have to do both, but in my opinion, it's a little easier to identify a zone because you're identifying, okay, this is overall where the support is, and this is overall where the resistance is. And you'll see as price trends into that area, it's going to reject and it's going to bounce off of those areas. So this is just a little breakdown on how to identify supply and demand, but I want to get into Q&A here because we are running a little late. So anyway, if anybody has any questions, please ask, whether it's charting, whatever it was, please ask your questions here. We'll do about 15 minutes of Q&A, excuse me, and then send everybody home, and we'll see you tomorrow for a further deeper look at charts and how we actually trade ourselves. So please drop the questions if you got them. Polanco, good question. He says, on scalping, use 1 minute candles to exit and trade. No, sir. For me personally, I just use the 5 minute. 1 minute is way too hectic because I've been looking at the 5 minutes since the beginning of time. So when I'm looking at a 1 minute, I'm thinking in 5 minute, but it's just a 1 minute candle. So it goes up and it comes back down, and I'm thinking it's a 5 minute candle, but it's actually just a 1 minute candle. And so that does not help me personally at all. However, there are traders that use the 1 minute, but that's honestly up to personal use. But the 5 minute, you're going to be relieving a lot of the emotions. You're going to see the trend moving in a little bit more time. So you're going to allow yourself a little bit more leeway to see, okay, the stock is continuing to push up here and we're breaking that resistance level, or okay, the stock is breaking down through the support level. The first 30 minutes of opening market then. What do you mean, Polanco?
In the 1 minute, on the first 30 minutes on a market that is volatile.
For me
No.
personally, Polanco, what I will do when it comes to that opening, I may look at that 1 minute just to see where that opening goes, but I will wait. Most scalp trades come off that 5 minute. It's just too much of a rubber band, especially in that first 30 minutes of trading. Well, in general, I'm referring to the first like 5 minutes of trading. But after that, you trade off that 5 minute because it's too much of a rubber band. It's too much of a bounce left and right. And those candles don't really get a chance to really fill out. And you don't get a true understanding of where that position is going on that 1 minute. Just bounces hectic. That's why I will stick to the 5 minute.
So this right here, Tico asks, can you go over the purple boxes again? The zone is in between, right? So this is the range of the price that the stock is trading in. As you can see, this is the obvious resistance. We're at when the stock comes to that level, it's going to reject down, reject down, reject down. This is the demand zone where when the stock comes down to that level, you're going to see a bounce, a bounce, a bounce, a bounce, etc. When it breaks, you know that then becomes the new supply zone. So you're going to see rejection and rejection thereafter. But we're going to go into that a little bit later tomorrow. But this is the range at which the stock is trading. Some people will just highlight the whole damn thing and understand, okay, this is your zone that the stock is trading in. And they're going to, in their head, recognize this is the lower level, the demand zone, the support level at which where the stock bounces. And this is where the resistance level or the supply zone is present, etc. So that is another way to look at it. If you want to identify, okay, this is your zone 1 here, and then you want to see, okay, this is your zone 2 here, etc. For me personally, I draw my zones where I'm looking at technical supply and demand zone is going to be a zone that is quantifying where your resistance is for the supply and where your support is for the demand zone, excuse me. So you're not going to be highlighting this whole thing because yes, on a large time frame, this is support overall, but I'm not trading going out months. I'm not trading going out weeks. I'm day trading. So I'm really looking at, okay, where is the stock going to bounce and where is the stock going to reject here? So we can go in here and we can mark up zones all through here if we really wanted to, but that's going to be that's going to be the main difference. Think of it as the whole range versus the actual zone at which where you see a resistance and support. Hopefully that answers the question. Correct, Tico. Support is demand, because think about it. Demand is buyers. That's where support is, right? And then resistance is sellers. Supply is sellers. Sellers, supply, demand, buyers. So you got your resistance, supply, support, demand. Okay, so didn't mean to say it. Got a direct message. Can you go over identifying fake breakthroughs again? So identifying a fake breakout, let's go down to, let's talk about an actual trade here. Let's just say, so you had like a, try to identify, let's go into a 5 minute here. Identify a trade. Okay, where's a fake breakout in here? Okay, so here's a fake breakout. So here, we're going to pay attention to this level over here. I just want to mark up some levels here so that I don't have to keep extending out. Boom. Mark this gap. Okay. Should I do that? We're going to mark the zone. So I'm always trading off zones. You see how this resistance or this support level, now resistance, but support level, and this resistance level right here, these levels, these key levels are really just zones. Every level is just a zone. Zone. So let's go into here on this false breakout, right? So you had your stock push up to this first, what would at the time be your supply zone, break above, come back down, break above, come back down, break above, come back down. So if you're looking at the stock and you're looking at it at the day, right? So this is the 16th of May and this is the 17th of May. So you'd be looking at this stock in position for a day trade, right? So you're looking at this May 17th, you're looking to take a day trade on it. And you saw this huge gap up. After this huge gap up, you have this resistance that's sitting here, the supply zone that's sitting here, supply zone 1, supply zone 2. Personally, looking at this just right off the bat as a blanket statement, I'm going to be very hesitant to trade this because we just saw a 4% gap up in the stock overnight. So just gapped up 4%. So do I really want to be 4% late to this trade? Because there's already 4% worth of the stock, people in the trade that gap the stock up. And now you have your next price target, sure. But am I looking to look for confirmation above this level? No, I don't need to be looking at this level because I missed the trade. Maybe if we hadn't gapped up or even just gapped up half of the price, I would have taken this resistance level up to this resistance level here, just looking left. But since we gapped all the way up to this resistance level, this lower resistance, now support, I'm late to the trade. I'm going to ignore this trade. But let's just say that we looked at it already, right? We were looking and interested in this trade. And it got to our supply zone here, and it was about to turn into demand, break through our resistance essentially, and then go to the next supply zone. The way that I'm looking for false breakouts is this is on the 5 minute. So your candle doesn't even confirm above this supply zone, right? So let's just zoom in a little bit here. You can see that this body right here, right? I'm going to go to the left here so you can actually see it. This body doesn't close above this supply zone. So it doesn't confirm any price action above, therefore, right? You had a push up, but we got to wait for that candle to close here. Because if we don't wait for the candle to close, you're going to get in on this candle, and then you're going to have the next candle absolutely rip your contract. And you're going to be a little scared at this point that you might have a harsh reversal, right? Looking for the potential V price action here all the way down, the mean reversion down to fill the gap. But if we wait for the confirmation candle above that level, in this case, it happens to be the zone in between 99.37 and 99.69, then we need to make sure we're looking for that confirmation candle, the candle that closes above it. And then personally, after we have a candle that closes above it, I want to see a secondary candle close above it. That's just me personally. And we're on the 5 minute, remember, so we're not on a 4 hour. This isn't 4 hour candles. This is 5 minute candles. So we want to see one confirmation above and then a secondary confirmation above. And then you know that you're okay to go. Now, here's another thing to keep in mind here. Not only are we really late to this trade, but $100 on a stock is always going to be a huge strike level. 25, 50, 75, 100, 125. Huge strike level at 100. So if we're trying to make this, let's see the actual percentage here, because we can do that, 0.7% move, not very good risk to reward there. I would rather watch this trade for a potential break above 100 once we have a confirmation, or if we're going to have a harsh rejection, trade the rejection of the 100 level. So This is an invalid trade from the start because we're late to the game, and our potential trade that we're looking at here, right above this supply zone to the next supply zone, is only 0.7 move, 0.8 move. That's not, I'm not interested in that. The risk to reward is going to be far better on another stock. You might have a 3% move in play or a 2% move in play rather than a 0.8% move after a 4% gap. So hopefully that's
Another
kind of
thing to
sense.
mention, when he was saying he would rather confirm over 100 and play that break of 100 and play the rest of it. We would rather pay more for a contract and have more confirmation than to get in early and be wrong and watch it reject that 100 level.
Do you use the price levels during a trade if it's not going your way to see if you should stay in the trade? Yes. So let's mark this up. Let's see. Okay, so let's get rid of this and let's just pretend. Good question, Tico. You got good questions. Let's just mark up this resistance, right? We're looking to trade above this resistance, and we're gonna say that we're gonna actually use this vertical line, which I said in the beginning that we would never use this vertical line, but we're gonna use this vertical line to mark the time of day. Just pretend that this is at open. This is from the time that we're trading on, and then let's say over here is close. Let's just arbitrarily, we're trading in between this zone here. Okay, so let's mark up our zones. That actually came in really, really clutch. So let's look to the left here, or just for ease, instead of looking to the left, let's do it anyway. Sorry. Okay, pretty on point support here. Resistance looks like you'd rather identify as a zone. You do have some resistance in here, but overall this is consolidation. So we want to turn to an hourly to see where the overall price action is closing inside of there. But for this example, let's just use these two resistance levels. So we're looking to take a trade above this 102 level to 102.86 and say that after open, we're watching the price. It comes up and rejects. No confirmation of trade. We don't take the entry. No candle close above, no secondary candle follow up, no entry on the trade, right? The trade is not good yet. It might be good, but we just broke up to rejected. Now we're watching, right? So as the stock is trending back up towards that level, you get the break, you get your confirmation candle above, you get your secondary confirmation, you're in the trade. It goes up to your level here. It's rejecting off the resistance, but now you just made this previous resistance a new support by being above it. So you're going to watch the stock for it to bounce off of it, right? Because you're intending to see this style of price action. You're intending and expecting price to go like that. So this is what we want to see. We've got a little bit of it. No, we've got a little bit of that here, right? We've got a price up, sideways, sideways, sideways. And then we reject our top level here. Great close above, but this is why we wait for a secondary close, because we have our secondary candle coming in as a big bearish engulfing candle, bearish engulfing where the sellers are engulfing all of the buyers, and then breaks down through your support. So in this instance, let's just hypothetically say and ignore the fact that this is a terrible risk to reward ratio here of a trade. But in this particular instance, hypothetically speaking, if we took our entry above our confirmation, above our resistance level towards our next resistance level, didn't sell at that level, didn't take any profit, we're in the full position, I'm using this support level and watching this support level as confirmation to bounce off of to continue to the upside. And the reason I'm doing so is because if we break this previous resistance, now support, I can expect that we are going to fall. And then if we need to identify, okay, where are we going to fall? Well, our first area that we're going to fall to before we see some support is going to be this level down here. And let's make this level orange. Let's make this level orange. So this orange level is the next area of support, which was previous resistance, then made support, now still support on this side, where we're going to see some type of buyers step back in. At that point, you're going to be red on the position. So that risk to reward run one right off the bat is no good. But hypothetically speaking, if we waited for our entry, took our entry, had the whole position, I'm watching this previous resistance, now support, as an area to make sure that we do not break to the downside. Because if we break to the downside, I can see us falling another point. And then if we break that support, I can see us falling another point down to 99, which is not what I want to be or where I want to be if I'm in the call side. So hopefully that makes a lot of sense.
For me personally, on his orange line, I would tuck that up towards the body. You pull it up just a little bit, Zach.
Yeah, I definitely wasn't being accurate.
No, you're good. But I would touch towards that body. Like he was saying, if we're watching for that break over 1-on-2, for me on the 5 minute, and Zach does this as well, I'll wait for 3 candles to confirm up. So I would have been up. We would have touched that. We would have touched that top of the box. We wouldn't have confirmed over it. So I would still wait to take some profit. Second candle came in, would be red, but we still didn't reject it. We're still in that yellow box. And then when you see that large candle push on over that our target at 102.86, that's where I would cut for some profit, because that move, how large that candle is, would move the stock at least move the contract about 10 to 20 dollars right there in that move. So you can see that happen. You can see it reject. And once it came back towards that yellow line, I would already be close to being out, because as we push back where it confirmed, we'd have to move our levels like Zach said. So then we'd be playing on this orange line right here. We would wait for that orange line to come back and retest. You would come back, you would see one candle, you would see that red candle break below. Zach, move your mouse to the first red candle underneath the orange. Yeah, right there. Okay, so if we're playing the 3 method, you're underneath that level. We're waiting for it to retest and come back up. You go 1, 2, 3. You'd be at that green candle pushing up. You would see 1 candle above, 2 candle aboves. You'd be right back to where that 102 play would come back in. I'd wait to play it up, and then you'd be going higher. But essentially, for me personally, I'd want a little higher range. If we're looking at just that 5 minutes, it'd be really hard to confirm a trade in there. I feel like you would get stopped in and out, so you'd have to be really accurate. That being said, if you were using a 4-to-1 and you did pick up your 4 contracts towards your top, and you made 1 cut where the first green candle pushed off, when you came down to your orange level and you confirmed back over, you could add that contract back in. It would lower your average on your contracts, and you'd be right back to playing the same play you were on.
All right, so Polanka, so let me see if I'm understanding this correctly. You're talking about a swing trade. So if you're in a swing trade, and let's just hypothetically say that right here, and let's just use this. Boom, you're in a swing trade, and let's just say these verticals are coming in clutch. Yo, I'm never talking bad about vertical lines again. So if you had a swing trade and you're on the call side, and then overnight the price receded back down, waiting to sell 15 minutes in the open, I mean, that's really subjective to the trade that you're in. Very, very subjective. Personally, I don't swing very much. I don't swing very much at all. So that doesn't necessarily apply to me. However, if I were to swing, I would personally wait for around 15 minutes, at least 5 minutes of price action. I want to know where that first 5-minute candle is going to edge out. I want to see where that next 5-minute candle or 10 minutes into open is kind of trading before I'm making a decision on my swing trade. But a lot of times a swing trader will have in mind, okay, I'm going to take this trade at the end of the day, and I'm going to not see my exit on the contract until it gets to say 105 or so. And that's really not going to come until like 10:30. So I know that I need to not look at the price action for 15 minutes, make sure I set a stop loss at this lower level or an alert to let me know when it breaks that support. And if it does, I'm out of the contract. Or otherwise, I'm not looking. I'm waiting for it to hit that 105, come back around 10:30. Or another way that swing traders operate is that they trade the very close. So they enter their position the last 10 minutes, the last 20 minutes, last 30 minutes, and they trade and they close it at open. They close it in the first 5 minutes because they're expecting that gap up or that gap down to occur. So hopefully that's making sense.
You should never swing a scalp. So that being said, I know that you do it personally. A lot of people never swing a scalp. And when you're looking on that bottom side as well, something that we've noticed is that when we were talking, let's refer back to time of day. So you've seen that reversal and continuations happen from that 11:30 to about that 1:30 point. Normally that 1:30 is where we've seen lows come back. And me as a swing trader, when I'm ending my trades, that's what I'm taking advantage of. Now, you're not really worried about that first 15 minutes to pass unless it's pushing past your stop loss or your take profits. That's the only way you would really worry about that when it comes to that. And you would have all your levels written out too. So that way, if it came to your stop loss or it came to the level where you needed to cut, you would already know where that was, or you're watching that take profit to push forward higher. So not necessarily your first 15 minutes, because that's also where you can capitalize if a play is still staying in your trading range. A, on an average down, if you're a little more advanced, or B, that's where if you are on the right direction of the trade, that's when your call is most likely going to reach the high premiums. That being said, like Zach said, If you're in a longer dated swing trade, you're not going to worry about your day to day. You're going to worry about where your contract is sitting and what your target is, and reference to where that contract is to where your ultimate goal is taking that swing trade.
So we'll take 2 more questions here, and then we'll wrap it up because it is 10:30. So if anybody has a last question, let's get it in here. But we're going to have a little recap in the beginning. We're going to have lots of examples to go over. Spencer's going to go over some trades that he's looking at for next week. I'm going to go over some trades I'm looking at for next week. We're both going to explain our strategies, what we're actually looking for in a trade. So tomorrow we're getting really in depth with this whole charting technique. And actually when it comes to, technical analysis and planning out your trades, etc. So
let's get that last questions in, because, being from the South, big boy's got to get his nap.
Yeah, I'm from the East. I also need a nap. No questions? No questions? Somebody might be typing. If not, we got 1 minute left. We're going to put 1 minute on the clock, 10:36.
1 minute on it. All right. Here we go.
See, Tico's got
So like you saw, Tico, you asked, do you make a gap call put strategy? That's like when you were looking at the Best Buy trade from earlier, you could take a 80 call and a 60 put and have that as your splits when you're looking for that gap up or down.
For me personally, when I'm trading gaps, I do love to trade gaps. So let's find a gap trade, right? Like this is the 5 minutes still. You're not going to be able to find your gaps on 5 minutes unless it's overnight. So let's go to the daily here. Let's find a gap really quick. Auto, one-click auto. Okay, gap. I'll look left in the gap. There's a gap here. Trying to find an example that's worth actually going through. Okay. This is actually not a bad example here. So if we zoom in, we're on the 4 hour here, so we'd want to drop down to the 5 minute, the daily, excuse me. But we see this big gap up, or rather, wait, was this what I was looking at? Yeah, this big gap up here. So we would want to watch price action. The next day you had this nice gap down. I would look potentially for support at this level right here. The reason being is your support and resistances on a gap or a window, like the Japanese call it, is going to be really significant. Really big support at the support levels, really big resistance at the resistance levels. That's why sometimes you see a stock will come down and then break above. In this case, you see a gap back down underneath this, what is previous resistance, new support, because there's lots of buyers sitting here and all the buyers left home and the sellers came in, pushed that stock down. So I would be looking potentially to take a long off the gap bottom here, that support, because I know that there's going to be a lot of buyers in that area, lots and lots of buyers, because the gap that made the people that made the gap happen and possible previously were the buyers at that level, right? So that previous resistance is now support. As you can see, it did bounce very nicely here. Whether the trade went well or not, because there's a little bit of a small trading range, is a different matter. However, that's how I would look if I'm either trading the break of the previous resistance down to where the bottom of the gap is, or trading the bounce off of the support or the rejection off the resistance, depending on how the gap looks in the chart. And then Poke says one thing about the fibs. So fibs, you should read the book, one, because I know you have it, or at least I think you have it. But fibs are really just an indicator where you're going to confirm what you've already got in your chart. So let's just drop some lines here. Draw one right here, right? And we're not drawing zones, but we're drawing lines. We're going to draw one right here. I want to do auto. Obviously, we have to draw one right here because I'm going to get into the point here in a second. Okay, so we're going to get in here. Boom. So let's just draw these 4 lines and let's use this as the low and this is the high. So a retracement is when you have price retrace from a top to a bottom, retracement. So therefore, when you get your fib fib retracement, you go from your top to your bottom. Pretty accurate, not identical, but pretty accurate. So here we go. So you can see that the levels that it puts out are in what looks like probably gibberish, but it's really calculated levels. Each level, it's either 0.236, 0.38, 0.5, 0.618, 0.786. I was trying to remember without looking. 0.786, and then 1. So those are your Fibonacci levels. It's based on the Fibonacci math. You can read about it. You go ahead and read a book about it, whatever. It's the golden ratio. You see it come across all over the place in nature. In stocks, it also occurs here. So your 61.8 or your 0.618 is going to be your highest level. They call it the golden level. It's called the golden level because you see a lot of times price will extend up to that level. And if it pushes back up to wherever that 100% is, that top, more likely than not, the stock is going to retrace back down to the 0.618 or the 61.8 fib level and then bounce off of it, and then vice versa. So you could have that extension up to that 61.8 and have an extreme resistance at that area. So you should expect big resistance and big support at that area. So this is more so just an indicator to confirm what you're putting on the chart for yourself, what you're identifying on the chart. Okay, so you want to put in your support and resistances. You want to put in there, just check it with a fib. You want to grab that high and then put it on the low of the chart, the time frame that you're looking at. And then does it confirm your levels? Are your levels way off? Are you now aware of the 0.618 that you weren't aware of before, like we just identified here, et cetera, et cetera. So you can also use it for smaller time frames. So for example, I use it on QQQ. And this is why early beginning of the week, I was like, nah, we're bouncing, because I pulled on the QQQ fib, and TOS is going to be a lot better for me on this, but I drew the fib from the high of the year, the all-time high, to the bottom of COVID, and we were at the 50. We already bounced on the 0.5. You can see the 0.5. If we extend this over, come on. How do we do this? Let's see if we can extend the lines. Boom, easy. So the 0.5, as you can see, we had bounced right off of it. So come Monday, after we had bounced off it, I was like, wait a second. I was like, bounced off of 0.5. So after I saw that, I began looking a little bit deeper. I started looking at my supply and demand levels, and I'm like, okay, we're oversold on the RSI on the 4-hour, which means that's a little bit shorter than a daily and a weekly. We're close on the daily, but we're there on the 4-hour. We're almost there on the daily. We're very close to oversold on the weekly. I'm like, okay, so we're pretty oversold here. I looked at what's called a put to call ratio, which is something that I only check for infrequently here and there. It's just the ratio of puts to calls. I saw that the ratio of puts to calls was at 1.05. So that's like maxed out. Now, on top of that, if you go to the VIX, which is the volatility indicator, the VIX was also maxing out about 35 or 36. So I put that all together and I'm like, yeah, the chances of our bounce here is pretty high. The bounce, I don't believe, is going to be very long. It's going to be very, not short-lived, but long-lived. However, I know that there's going to be some type of bounce occurring here. So I'm going to start marking my levels to the upside. If I see bounces going on in QQQ, I'm going to look towards the stocks that I know are really, really bullish right now. Bullish, meaning that there are lots and lots of buyers stepping into the stock, and that was AMD. So I was super focused on AMD because QQQ is bouncing, and every time QQQ gets a little bit of buyers, AMD gets 10 times the amount of buyers. So that's what I should be looking at, right? Because if we are going to bounce in QQQ, all the people's eyes are going to be on AMD, AMD, AMD. And there's other stocks that were strong as well, Roblox, etc. So I was focused on those stocks. So that's what you can use Fibonacci's for. But as for me personally, I don't use them too much. I do draw them occasionally just to check out on larger time frames. Okay, we just broke the 71. The 0.78, 0.6. Okay, our 61.8 level is sitting our previous support. Okay, we can see some support at that level. Let me make sure and identify, okay, do I have a zone there? Do I not have a zone there? Et cetera, et cetera. I don't ever use I'm never snapping a trade. I'm never snapping a fib during a trade. So I just make sure I take this is just me personally. I just make sure I take the sentiment how it is. If the fib is, if the level is at, it came back from 100% at 61.8, paying attention to that level. Okay, we're bouncing pretty hard. Okay, I'm going to keep my eyes on this as a bullish remark, but as for me personally, when I'm in a trade, I'm not snapping a fib, and it's not doing much for me when I'm in a trade. That's just me personally, though. Tico, yeah. Yeah, pretty much. I mean, Apple has been kind of the naysay of what's going on in the market. But, another
Except
thing
for
to
one
note
point
is that
last
does
week.
change.
There was one point last week where it went inverse. QQQ
Yeah.
had its bounce and Apple stayed down.
Yeah, that was a little scary to me. I was like, I don't know if I can take some calls here because Apple's really not leading the pack very
She
well.
walked herself down though, so it was all right.
All right, so that was the last question. We're going to pick it up tomorrow, but thank you guys for staying. You guys are great, asking lots and lots of questions. The feedback is good. The engagement is good. We like that because that helps us help you guys learn a lot more of the content that we're actually bringing to you guys. So again, if you had questions that you want to go a little bit more in depth on, either message Spencer or I inside of the Discord. And that way you guys can get your questions answered. If we did not already answer it, let me make sure to get a link for anybody that's not in the Discord. We do have a separate Discord specifically for this. That way it can be a lot more focused. We can make sure that we've actually got, people asking questions that are relevant to what's going on in the class. And that way you don't have people talking back and forth. That's the link to the Discord right there, and chatting about X, Y, and Z. There will also be, after we finish, we're going to have quizzes that'll come out. So you guys will be able to see, okay, we're going to basically put out, this is your supply zone, this is your resistance zone. What do you do at these levels? Or your demand zone, excuse me. What do you do at these levels? So we'll have quizzes. Good stuff is going to go in there. The presentation, some of the presentation slides are going to be in there. And of course, we're going to upload this video. It may or may not be posted by tonight because I'm going to leave my computer after this. So you might not get the link until tomorrow morning, just so you guys know. But anyway, thank you guys very much for staying with us the whole time, us chatting your ears off. I hope you guys learned a lot. Tomorrow, we're going to get into the nitty gritty of what it's like to actually identify your different zones on a chart, how to trade those zones, what to keep in mind when you're trading. Is it a downtrend? Is it an uptrend? What are we looking at a chart? And what are we worried about when we're in a trade? And we're also going to go a lot more in depth on what is Spencer's strategy for trading, what is my strategy for trading. So we're going to spend a lot of time tomorrow in the charts, looking at examples, looking at trades literally that are next week. This is perfect because it's a Sunday, so we kind of have to do it anyway. So we're going to do it with you guys. We're going to be looking at some trades that we want to look for next week, and we're interested for next week. So anyway, with that being said, really great to see you guys again. I hope you guys enjoyed. I hope you guys got a lot of value out of this. Hope you guys, your notebooks are filled up like that. Hope they're filled up. And anyway, we'll see you guys tomorrow, and peace out.
Yep. Y'all get some beauty sleep or a beer. See you tomorrow.
Night, guys.
Or